fund industry, plenty of negative headlines to pass there. The 10-year yield, 4.16% is where we trade right now. Goldman Sachs adjusting their outlook for where they see the Fed next year. The end of June is when they now see rates starting to be cut by the Federal Reserve. We are at 144. That's the handle on dollar yen. We've been through 145. Some people say that number matters. Others say the volatility is what really matters. And here's the Brent crude price, 85.75. A lot of weeks of positivity for Brent crude prices, down a little on the back of that China nervousness. And it's the China nervousness that weighs on European futures as well. So DAX futures pretty flat. FTSE futures down 0.1%. CAC futures down 0.2%. So negativity really being driven by that higher yield environment, higher yield story, that this hangover from Friday and continues to be something we talk about this morning, but also by the China news. So that China news flow weighing on sentiment into the European session and on US futures as well. So the start of European trading then gives us a very lackluster performance on the FTSE 100. No other markets yet showing up on this GMM screen, but we are seeing a bit of weakness coming through on the FTSE then. The pound also a little weaker, the euro a little weaker, and that goes to the strength of the dollar, which you also see on the Forex column there. The dollar up 0.1%, and again, that's one of those themes from Friday that we're picking up on. Higher yield, stronger dollar seemed to be one of the plays on Friday, as was weakness in the commodity space, and that continues to be the case. Partly driven by China, partly driven by that dollar strength as well. So Brent crude, as we've mentioned, down by 1.3%, and a mixed bag, of course, when it comes to the fixed income space, as you see in the sovereign bond column. A negative, flat to negative start for European trade on what is a relatively quiet Monday, but plenty to talk about with some interesting news lines around M&A and some of the European corporate stories in focus. So this is the Stocks Europe 600, down by 0.1% this morning. As we've said, a little bit of negativity coming through. In terms of sectors then, a couple of sectors in positive territory only this morning. The food and beverage sector up by 0.25%. Retail, pretty flat this morning. Elsewhere, we're looking at losses for the basic resource sector, so thinking about the weakness we've seen in commodity prices, iron ore, oil prices all weaker, and so basic resource stocks down by 1.1%. That seems to be one of the worst performers this morning, which of course makes perfect sense. Getting back to the driver then of that negative sentiment around basic resources, Christine Aquino still with us from the Markets Today blog, and China really is the focus for us, isn't it, Christine, in terms of the weekend news flow. Country Garden once again in focus. Take us through the news lines that have caught your eye.
Absolutely, Anna. I think it really is the focus at the moment in China is whether more property developers will follow Country Garden in struggling with its debt load. And this also comes at quite an inconvenient time. We're going to get data from China tomorrow that will give us a better look at how the economy is doing. We know it's not been doing great. And the focus really in tomorrow's figures is going to be all about that property investment. The expectation is for a further contraction there. And so bad news across the property sector all around, and just increasing pressure put on the government to really deliver that fiscal stimulus that so far they have opted to not deliver because they're probably wanting to save their powder for a rainy day, but perhaps this might be the rainy day we're looking for.
Is it raining, I suppose, is the question. So we look to the data then tomorrow, don't we, Christine, to get a sense of whether it is still raining on the Chinese economy. So that's one thing we're dealing with, is negative sentiment coming through from China. As we look ahead this week, we're also going to get a lot of key data out on the UK. Could we finally see inflation drop below a 7% handle? That seems to be the expectation. What are you going to be watching for?
Yeah, that's definitely the big figure, Anna, is inflation. And again, that 7% figure, very significant, just because we have have seen just a decline in the headline inflation figure over the last couple of months. Perhaps not as quickly as investors are probably hoping for, but we could finally see that. But then, of course, we have the jobs figures as well. The other key thing here is going to be watching for that wage growth number. That was the key surprise last time around, and it really will be a key indicator of how inflation, not just overall in the UK, but specifically in the job market, how sticky is that really? But we did get a growth surprise last week, Anna. So maybe what we're looking at the UK is those recession fears may not come to fruition, and maybe it's just a vibe session, a recession in name only, which is what we've been calling it over in the Markets Today blog.
Yeah, the vibe session, I like that, but where the sentiment seems to be guiding things rather than the data. Let me ask you about our sentiment towards vacation, holiday. This seems to be something that the Markets Live team have taken a deep dive focus on. What have you been asking readers of the Markets Live blog, and what have the responses looked like?
Well, Anna, I think the focus very much is on which companies will outperform on the S&P 500 specifically. And yes, vacation is on the brain for a lot of our Markets Live readers. They are saying that companies that offer that unlimited time off package, we have seen a number of companies starting to do this to entice more employees to their companies, right? In the era of flexible working, and this is one of the perks.
Tight labor markets.
Exactly. And so they do see an advantage for these companies to outperform the S&P 500. But, who knows if that is very much a factor. It's certainly a factor for enticing talent into the company, especially because, there's flexible working is all the rage now.
It is. And apparently, according to the survey, though, so people might be taking or might be enjoying the opportunity to take the vacation, not necessarily taking a lot of it, but they are reading their emails. I was quite shocked to see the number of people reading their emails on the beach. This is a thing, Christine.
It's very worrying. Take your vacation days. Come on. I mean, enjoy it.
I only read emails from Christine and from Mark, I should tell you, on my vacations. Right, thanks to Christine Aquino from our Markets Today blog for joining us. You can get more on all of those stories. The front page of the Bloomberg UK website takes you there. You can click through onto the Markets Today blog, or you can type TLIV, go onto the Bloomberg terminal. Let's check in on some of the individual stocks that are on the move. And Joe rightly drew our attention to Philips. Joe Easton, that is, from our equities team. Good morning once again, Joe. And Philips is one of the stocks that are very much in focus this morning.
So Philips, Anna, is the biggest gainer in early trading on the stock 600, up around 6% now, as we see on the screen here, as the Agnelli family's Exor takes a 15% stake in the Dutch health tech firm. That could rise to around 20%. That's worth around 2.6 billion euros. We're seeing Exor, which is actually listed in Amsterdam alongside Philips. That one coming down slightly. They're obviously having to pay out quite a big fee for their stake in Philips, but that's the big story in terms of the movers this morning. Then UBS, there is a piece out saying that some retail investors in Credit Suisse aren't happy with the terms of the deal of the takeover. They could potentially take that to court. So there is a bit of uncertainty there. So we brought that one up, but pretty much unchanged at the moment for UBS. Then looking at Plus 500, now this is the online trading company, the retail trading firm, CFD Trading, so you can trade securities without owning them. That one up 3%. They reiterate their outlook this morning in a statement. There's concern that people will start cutting back on trading due to the cost of living crisis, but we're not seeing that from Plus 500 at the moment today. Then we're going to flip over and look at some auto stocks, as we mentioned in Stocks to Watch. Price war over in China, with Tesla cutting their costs of some of their highest level models in terms of the Y model, one of their highest price models, down around $2,000 in terms of their pricing. That's weighing on BMW and Volkswagen, given that these companies earn around a third of their sales over in China. In terms of real estate, we've got TAG Immobilien over in Germany. Now, I thought that one didn't look too bad. There is obviously a lot of negativity priced into German real estate and European real estate in general, but there is some positivity on rents potentially coming back up. But we're seeing that one dropping as much as 5% over on the Xetra exchange. Still a lot of negativity on that sector. We've also got British Land in the same space in real estate. Now, they could be getting around £300 million from a US investor selling some of their assets that aren't generating much at the moment. That stock was down last week as they lost their place in one of the key MSCI indexes as well. But that one just ticking back to almost unchanged from British Land. Then in terms of a couple of ratings changes that we always look at, at the end. So Quilter, now this one gets a new buy rating over at JP Morgan. I haven't actually seen this note, so if you do see it on your desk, do me a favour, send it over so I can have a read. But that one is upgraded over at JPM. Meanwhile, Gerresheimer, probably mispronouncing that one as well, but this is a German maker of medical packaging stocks. They get a buy rating at Jefferies, who thinks that their margins are improving due to the supply issues. And Bechtel also got a new buy rating after the office supplier increases its market share according to their earnings report, which was out just on Friday. That one up around 0.6%, Anna.
Excellent. Thank you, Joe Easton, with all the difficult to pronounce German names this morning from our equities team. Thank you very much for the update. Let's get a look at some of the things that are on our radar for this week. A week ahead look for you. Tomorrow we'll get data out from China. As we heard from Christine Aquino, a lot at stake here, given the weakness that we've seen in certain parts of the Chinese economy of late. UK employment numbers and US retail sales will also hit tomorrow. Then on Wednesday, we'll get the other part of the UK data set. That's inflation data due out for July. Will we get that 6.8% that is the estimate on the Waco function on the Bloomberg terminal? We'll also get minutes from the Federal Reserve's latest meeting, the FOMC's meeting last month, of course. Then on Thursday, Norway's central bank, Norges Bank, will deliver its latest rate decision. And to round out the week, we will be getting Japanese CPI. We'll be watching for that CPI reading for July, due out on Friday. I think we've got some GDP data coming ahead of that earlier on this week from Japan as well. Coming up, we'll be thinking about the Fed. Goldman predicts a first Fed rate cut next summer. We'll discuss that next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Tuesday, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the countries.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
This is Markets Today. Welcome back to the programme, everybody. It's Monday morning. We're 12 minutes into the European session. You can see actually quite a mixed picture, flat to negative perhaps for European equity markets. We see some weakness coming through on some of these markets. The CAC 40 down by 0.2%. The FTSE getting the worst of the losses, down by 0.3%. Some weakness in basic resource stocks often is the guiding factor there, and we have seen that as a weakening sector this morning. Let's get back to the broader macro picture. Economists at Goldman Sachs are predicting that the Fed will start cutting US interest rates by the end of next June. The Wall Street Bank anticipates 25 basis point cuts coming each quarter. It also says there will be no more rate hikes this year. Now joining us, I'm pleased to say, is Alfonso Pecatiello, who is the founder and CEO of the Macro Compass, to talk about all things markets. Alfonso, thank you so much for talking to us this morning. Nice to speak to you. Let's start with the Goldman Sachs call then on the Fed. They're talking about rate cuts starting June next year, so the end of the second quarter. There was a time when that expectation in markets would have been wildly out of kilter with what the Fed themselves are expecting, but it seems that the Fed now also expecting some cuts towards the end of next year. Where are you positioned, or what are you thinking when it comes to the Fed's trajectory from here?
And I think the Fed will be cutting in March, April next year, so a bit earlier than what Goldman Sachs expects. I also believe the Fed has stopped hiking for this cycle. So I do agree there. Look, there has been a change in shift when it comes to the narrative around what Powell and Williams and other heavyweights at the Fed are telling us. And we should always listen to their speeches and what they're saying. And they basically have changed tune by using the opposite sentence, but exactly the same argument that Draghi was using when he was the ECB president in Sintra 2017. So back then, the European economy was accelerating and ECB interest rates were negative. The deposit rate was negative. So Draghi was basically saying, if we keep interest rates negative in Europe while the economy accelerates, we are easing policy further. And now Powell and Williams are saying exactly the opposite, but using the same argument. As the US economy, both in real terms and in inflation-adjusted terms, or in nominal terms, it is slowing down. If we keep interest rates at 5.25% over time, we'll keep adding tightening pressure mechanically because the economy is slowing. And so if we keep rates that high, we are mechanically tightening. We need to cut rates to accompany basically the slowdown, make it sure it doesn't turn into a recession at the end of the day. So the Fed is basically telling us we will be cutting in 2024. The pace and the extent of the nominal growth slowdown will determine how soon and how much they cut. I believe March, April 2024 is the first, live date for a Fed cut.
Okay, really interesting analysis then. So that Powell and Williams and co sort of riffing off Sintra 2017, but with the opposite take. A very interesting perspective you give us there. So I guess that raises the question of how much cutting we'll see then next year, because if this is sort of cutting to stand still, how much will be required?
So look, there are two cutting cycles that central banks generally pull off. One is a disinflationary soft landing cutting cycle, and that would basically mean that the Fed has to bring rates back to neutral. Now, nominal neutral rate, according to the Federal Reserve, is 2.75%, roughly around this area. So that means we're going to be cutting about 200, 250 basis points over time. It can take a year and a half. It's a gentle cutting cycle. That only comes true if you don't get a recession or a credit event. If you get a credit event or a recession, historically, the Federal Reserve ends up cutting 300, 400 basis points. Basically, the game plan will be the same as 2001, where the Fed raised interest rates all the way above 5%, and then they had to cut them basically back to zero in the next 15 months. I am leaning more on the side of the aggressive cutting cycle. The reason is that the bond market action of the last few weeks is really reminiscent of a late cycle bear steepening that generally tends to accelerate the tightening of monetary conditions, of credit conditions through the economy, right at a point when the economy is indeed slowing. That tends to increase the odds of a credit event or a recession down the road.
Okay, so because of a credit event or a recession down the road, you expect then that we could see this more aggressive cutting. But I'm interested in this idea that even then, Alfonso, from your description, even if we get something like a soft landing, which seems to be talked about a lot, doesn't sound like that's your base case. But even if we get something like a soft landing, you still think that the Fed cuts sort of 200, 250 basis points?
That's correct. I mean, the idea is that unless you think that equilibrium rates for the economy have materially changed after the pandemic, which would mean basically the economy can function and produce potential GDP growth with higher equilibrium interest rates. I don't think that's the case really, because that is all determined by mostly demographics, productivity, private debt levels. Those haven't really improved since the pandemic. So I really don't see the argument why long term the economy would be able to sustain higher interest rates. If that's not the case, then you're looking at a cutting cycle back to the good old nominal neutral rates around 2.75%. It won't happen all in 2024, but in a year and a half, maybe 2 years, the Fed will be cutting all the way back to 2.75, which is nominal neutral rate in case of a soft landing.
Okay, but if we assume something more negative, what is it about the bond market and the way it's positioned, this bear steepening you referenced, Alfonso, what is it about that that makes you worried about the mixture of that at a time that the US economy is slowing, and you reference something breaking? What is likely to break?
Look, Anna, the dynamics are the following. The tightening in credit conditions, the yield curve inversion, and everything we see, it normally takes time, the famous variable lags to which this tightening plays through the economy. These lags can take all the way up to 2 years. So generally, after 12 to 15 months, people start to get frustrated. They're like, where is the tightening? I mean, the economy can run apparently with these higher interest rates. What they do then is they push the tightening further down the curve. So the curve bear steepens. The aggressiveness of that for the economy is twofold. The first is that credit becomes ultra expensive. Leverage becomes really expensive also at the long end. So see third-year mortgage rates, for example, they really rapidly increase with the bear steepening. And the second is that the leveraged business models like pension funds, real estate, or anything like that, when you move the tightening at the long end, the negative mark-to-market effects are much more powerful for these leveraged structures. So down the road, normally late cycle with an economy slowing and the bear steepening, you tend to have some damage. The playbook would be late 2018, for example, but you had the same bear steepening late cycle also in the second half of 2007 and in the second half of 2000. So it is really a dangerous action by bond markets. And where does it break? Of course, hard to say. The usual suspects are highly leveraged business models, real estate, pension funds, shadow banking, credit markets in general. Those are the top suspects.
Okay, so we'll write those down as areas to watch. So soft landing then, Alfonso, it's a myth. It can't be achieved, you don't think?
Well, always hard to discard and put a 0% probability to anything, but it always looks like a soft landing just when the economy is slowing. When you slow down an economy from very hot and you slow it down, it obviously, the intermediate step always looks like a soft landing. History says that with such an aggressive tightening, sustained over time, like we are doing, it is pretty rare for the Federal Reserve to engineer soft landing indeed.
Alfonso, thank you so much. Thanks for joining us. Alfonso Peccatiello, founder and CEO of the Macro Compass. Really good to get your perspective. Coming up on the program, we'll talk about autos. Tesla slashes prices again in China as competition with local rivals heats up. What's at stake for European car makers with that in context? More on that next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations.
Let's check in what you need to know.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Markets Today. We are 23 minutes into our European trading session, and flat to negative, I suppose, is the best way, or maybe mixed, really, to describe what's going on here. European stocks as a whole are down 0.1%. We see some variation between the UK and the German market. The German market, actually, and the Spanish and Italian markets bouncing a little this morning. The London market, really, just the one dragging things down. Let's talk about what's happening with Tesla and the auto sector. Tesla has rolled out a new round of price cuts in China. The move sent local auto stocks tumbling on concerns it will re-spark a bruising price war that had showed signs of abating. What's at stake here then? What's happening? Let's talk to Craig Trudell, who oversees our autos coverage here at Bloomberg and can give us some insights. Craig, very nice to have you here with me to explain all of this then. So is this a surprise that we see more price cutting from Tesla in China?
Yeah, we may have thought that we were done in China. You mentioned off the top sort of signs of abating. We even had a sort of curious announcement of an agreement among manufacturers to kind of call a truce, and that lasted all of a couple of days. I think what we learned in the sort of following weeks was, from Elon Musk himself talking about this idea that, price cuts, he would not rule out continuing to bring pricing down. He specifically was citing interest rates. I think rather than that being a factor in China, it's more a factor of just, the amount of competition in that market, how competitive it is, how crowded it is, and how much the Chinese manufacturers in particular have really proven strong. I think BYD in particular is really bringing up an awful lot of volume and creating a lot of competitive pressure for Tesla to have to answer.
Right. It's really interesting to look at the way that the competitive pressure is the same and also different in different geographies. So why is there so much pricing pressure from this competitive environment then in China?
I think we're seeing a pattern of sort of, as costs come down, as input costs come down. We saw the last couple of years, not only the semiconductor crisis putting some pressure on companies, but also raw materials for batteries. So lithium and nickel prices in particular really being a difficult challenge for these companies to work through. Those prices have come back down. We've seen, with China having this huge lead in terms of getting a battery supply chain up and running, we tend to see, as prices come down, China, price is able to come down first. And so perhaps we see that spread to other markets.
So perhaps that spreads, which is interesting in terms of read across into Europe and elsewhere. So we've seen this weighing on the share prices of some of the manufacturers in China. Is there hope that this stabilizes just briefly then, Craig, from here?
If you're looking at Tesla, I think the big sort of reason for hope in the next few months is Tesla did announce that this quarter they were going to take some downtime at their plants globally, and so there's some hope that that is related to factory upgrades to make new versions of the Model 3. If they have some fresher product, perhaps that can support stronger prices.
Craig, thank you so much. Bloomberg's Craig Trudell on the auto sector. Coming up, we'll talk about the ECB. This is Bloomberg.
not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Markets Today, 30 minutes into our European trading day. Here are your headlines. European stocks are flat after Asian equities sell off amid rising concerns over China's recovery as the crisis deepens at property developer Country Garden. Philips tops the Stock 600 after the Agnelli family's Exor says it will buy a 15% stake in the Dutch medical tech company. And iPhone maker Honhai, also known as Foxconn, says it expects sales to fall this year as muted demand for smartphones continues. This is the picture then for European equity markets right now. Just half an hour into the European session, we have a little bit of a mixed picture actually coming through. The DAX up by 0.2%. The FTSE perhaps weighed down by the basic resource sector. We'll check on that in a moment. Down by 0.3%. Overall, they're not going anywhere in a hurry for a Monday in August with fairly limited news flow. And let's face it, probably a lot of people still on the beach. So this is what we have for European stocks right now. Let's get to the sector picture though, because this does tell us something interesting about the news flow we have had surrounding China and the news flow still to come, in fact, around China. So basic resource stocks, you'll see down by just over 1%. Energy stocks also weaker. All of that playing badly for London. That weighs on the FTSE 100. That explains the underperformance we're seeing in the FTSE versus other markets, certainly versus the DAX, where we see markets up by 0.2%. So that weakness in energy and basic resources, really a reflection of the China story. Ongoing concerns around the property market there. Wealth managers, hedge funds, a host of negative news lines coming through from China over the weekend. All of that weighs on sentiment a little bit into the European session. So and towards the US session. Or I should point out, though, that US futures, it's only E-minis and NASDAQ futures, now just into positive territory with all of that in mind. Let's pivot then from the China growth story to Europe. They are connected. Economists say that the ECB will deliver one final increase in rates next month. According to Bloomberg's poll, the deposit rate will be lifted to 4% in September. At the same time, respondents reckon officials will start cutting borrowing costs next March, a month earlier than they had previously thought. Let's bring in Bloomberg's Zoe Schneeweiss with the details here of this survey of economists. Zoe, very nice to have you with us. So economists predicting one more hike in September. What happens after that? I suppose that's the key question.
So yes, as you mentioned, they are going to, economists predict that the ECB is going to hike again next month. That's something that, just as a reminder, Christine Lagarde, the ECB president, left open at her last rate decision. She said they could hike, they could hold. So economists think it is going to be a hike, but they say it'll be the final hike. Now the question is, how long will the ECB stay at peak rates after that? In the past, the peak has never been all that long. In year one of the ECB, back in 2000, it was 7 months. Other peaks were more like 3 months or 4 months. So economists now are saying it's going to be 6 months. So there will be a cut in March. Then they don't see another cut until September. So again, those in both cases are 25 basis point cuts. So Interesting thing, the ECB, however, we have the impression will try to always hint more is possible even after that hike in September, just because they want to indicate we might hold at peak for quite a while.
Okay, that's interesting. So we'll look to the guidance then to tell us a little bit more in September if we get that hike about whether that means we hold for a long or a short period. So does that mean the fight against inflation is won, Zoe? If markets or economists surveyed are suggesting just one more hike from the ECB, does that give us a sense that the battle against inflation is won?
Well, not quite, unfortunately. If we look at the data, that 2% that the ECB is targeting, or that the ECB wants inflation to be at, just is proven to be quite elusive. So inflation is going to slow considerably, but what worries here is that core inflation now already is stronger than headline inflation. So core inflation is the measure that strips out volatile elements like energy and food, and that now is stronger, and economists predict that through the end of their forecasting horizon, in this case that's through 2025, it'll stay stronger. So that is one of those things that just means that the underlying elements there are quite persistent, and that just means that inflation will take quite a while, and that 2% does still seem to be elusive.
And so what are the next things you're watching out for? I know that the spike in gas prices we saw last week, Zoe, got a lot of people's attention in terms of thinking about whether we see a reacceleration of inflation and how that storage looks going into the winter for gas. What are you watching out for?
Exactly, those numbers, but that'll take a little bit to feed through. What we're getting this week is on Wednesday, we are getting a second reading for GDP. As a reminder, the euro area was surprisingly strong in the second quarter, grew 0.3%. So we'll have more numbers and we'll give a fuller picture of that. And then on Friday, we get a second reading of inflation. So inflation numbers have recently been revised most times on the second reading. So we'll see if that happens again. And then next week, we've got Jackson Hole next week, so almost 2 weeks from now. And that is one of those events that doesn't just set the autumn agenda for the Fed, but for the European Central Bank as well. And we'll be watching that one very closely.
We'll certainly watch that then. Thank you very much, Zoe, for the update. Bloomberg's Zoe Schneeweiss with an update there on the ECB. Let us get an important update on what's going on with Country Garden. This, of course, is the property development business in China at the center of the most recent concerns around property and the sustainability of debt levels within the property sector in China. Country Garden is seeking to extend the maturing yuan bond over 3 years. And this, of course, is the latest news line coming through then on a developing story, seeking to extend a maturing bond for the first time in a sign of this increasing urgency amid a worsening cash crunch that's exacerbating the country's broader property debt crisis. So reads the first paragraph of the detailed story we have from colleagues here. This news comes after other people had said last week that Country Garden was considering extending some soon-to-mature securities. So confirmation of what we had been led to believe last week. So interesting to get that this morning. And you see reaction to this on the markets this morning. Country Garden on the screen for you, and the Hang Seng down by 1.8%. And clearly concerns around China, the property sector, and other parts of the Chinese economy weighing on the broader Chinese markets, and in particular the Hang Seng. We get important data coming out of China during tomorrow's trading day. Let us check in on the individual stocks on the move here in Europe. Joe Easton has a briefing. Joe?
So Philips, Anna, holding on to gains of around 4% after around half an hour of trading. It was up about 5% earlier this as the Agnelli's Exor family buys a 15% stake. However, I've just read the ING note, and they say, the ING bank over in Amsterdam, they say that investors might be cautious on this deal, given investors don't generally like minority stakes in terms of big investors coming in. So a bit of caution there. ING also has a hold rating generally on that stock due to concern around that sleep apnea products recall. Meanwhile, Siemens, now this one we didn't have pre-market, but they've been upgraded over at Berenberg. Berenberg says that the market was overly sensitive to Siemens earnings last week, where the stock dropped due to a slowdown in some of its China factory business. And as I say, they rate a buy on Siemens, and that stock up around 0.9% at the moment. Plus 500, the online trading company. The big thing pushing this stock higher is the dividend. The dividend's bigger than expected. People aren't slowing down on online trading at the moment, and that's allowing Plus to return more cash to shareholders, according to the company today. I've also brought up Watches of Switzerland. No specific news today, but that stock pushing higher after a positive earnings update last week. The US sales was really strong. The Americans love their Rolex watches, according to Watches of Switzerland, and that one is up around 2.5% in London today. And in terms of the losers, the red board, we're going to flip over and have a look at those. So Volkswagen, that one was down almost 1%, now just 0.3%. This is the Tesla price worries, Tesla cutting prices, as Craig Trudell was discussing just a few minutes ago. That one down around 0.4%, given worries about some of these pricing wars over in Asia. TAG Immobilien, that one was down 5% in early trading, now down 3%. They are suffering on German rents. The rents over in Germany, their home market, not growing as much as expected. Obviously, those stocks have come down a lot given the higher interest rates. So that one hit today down around 3%. Shell, I've brought up just because of the general move lower in oil stocks, have you been mentioning, with Chinese growth concerns around the data that's coming out overnight. We get industrial production data from China. That's expected to be weak, and all the commodities prices are declining. So Shell weighing on the FTSE 100 today. Then finally, Dowlais. Now, this was the company spun out of Melrose. It was a new IPO just in April. Not a good time to be listing on the London Stock Exchange at the moment, but they did do that, and that stock is still trading below where it IPO'd just a few months ago, down another 2% today. This company does automation in the auto space and also planes, that kind of thing. It used to be known as GKN, now known as Dowlais, down 2% on the London market.
Thank you very much. Thanks for the translation. Joe Easton from our equities team with the latest movers on the market this morning, this Monday. Coming up, we'll focus in on the commodities sector. Gas supply risks are mounting as Europe heads towards autumn. We will discuss the outlook next. A lot of focus on Australia and the labour market story there, how that could become a global influence. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Markets Today, 42 minutes into the European trading session for this Monday morning. And European futures look fairly mixed. European stocks actually look fairly mixed, don't they? We're pretty flat overall, but the FTSE underperforms. The Xetra-DAX over in Germany outperforms, as does the FTSE MIB in Italy. Let's get back to the underlying commodities story that has so dominated over the last couple of years in terms of the European economy. Gas is back as a risk to the global economy. Potential strikes in major producer Australia threaten to shatter the fragile balance of global supplies and send consumer bills rising once more. For more on this natural gas story, let's get to our natural gas reporter, Anna Shiraevska, who can tell us a little bit more detail here. Anna, good morning to you. So let me ask you about why on earth are we watching the potential for a strike in Australia when it comes to the bills that people pay in Europe? What's the linkage here?
Good morning. Australia is among top 3 LNG producers. So even though that supply mainly goes to Asian consumers such as Japan, China, Taiwan and Thailand, but if that supply is disrupted, and we are talking about potential 10% of global supply at risk, these Asian buyers would have to resort to pulling supply from the Atlantic basin, and that's the US. And the US is the biggest supplier of LNG to Europe. So potentially, if prices rise in Asia, Asian consumers pull that supply, and we have an implications for the European gas market.
So that's the linkage, and that's what happens when you can move this gas around the world, as you can with LNG. So are we likely to see strike activity in Australia? I think I read over the weekend it could start as soon as today. Is this likely to happen, and could it be as disruptive as feared?
The talks between the labour unions and project operators are continuing. In fact, the next round of talks is tomorrow. So we will find out more if the strikes could be averted or if they'll go ahead. Now, the implication will be also how long these strikes could last, because if we approach the winter peak demand season, that could actually implications could be much higher. So we are about to watch tomorrow if there'll be any result from the negotiations between the unions and the companies.
Okay, so we continue to watch those negotiations then on that labour market story in Australia. What does this mean for Europe in terms of the level of preparedness for the winter? What are we seeing at the moment? How prepared are we for the winter compared to where we would usually be? Because last winter we actually managed to go into the winter with high levels of storage, didn't we?
We did, and this year Europe is well prepared as well. The storage size at 89% full, so we are well ahead in building these inventories for the winter. We are still a few weeks away before the heating season starts, so there's nothing to worry just yet. But because the market is so volatile, and any supply disruption could lead to exponential spikes in prices. We've seen that before. We saw it last year. Now this year, of course, the prices are much lower, but it will still be an impact if we do see actual reduction in supply, and especially if it's combined with any other supply disruptions elsewhere. We are in the middle of the US hurricane season, so that we're still something to watch. It hasn't happened yet, but if there is disruption happens, combined to Australian strikes, and then if demand goes up in China, for example, that could lead to more implications to the market.
Yeah, it's amazing, isn't it, how that spike up from 30 to 42 or so last week, if you pull out and look at that on a longer time horizon, doesn't even stand out, even though in a historic context that is still an elevated level of gas price, isn't it? How does the US market play in here then, the US LNG supply side of things? Is that a factor to watch as well?
Yes, as I said, the US is the biggest supplier of LNG to Europe, and since last year's Russian invasion of Ukraine, Europe really depends on LNG as a global market, and US is a flexible supplier, so US LNG can flow to the highest paying market, the highest demand market, and that's been Europe so far. So we have to see that Europe continues attract that US LNG. So yeah, the watch is on the hurricane season to see how that evolves. We saw in the past hurricanes can disrupt US LNG facilities in the Gulf Coast, so that implication could be significant if it happens. And the odds are that it could be an active hurricane season because the temperatures, ocean temperatures are rising. So that's the US forecasters are saying.
Okay, and that matters for other commodities, of course, as well. What about the Chinese demand side then? You mentioned how this is, of course, a global market, and this is why what happens in Australia matters, because if they supply Asia, that will have an impact. If there's less supply going to Asia, that'll have an impact on other supply elsewhere. What are we seeing from a demand side, though, in China? Because because a lot of this program we've spent talking about weakness in Chinese data. We'll get more data tomorrow on China. I suppose one of the silver linings of that weaker demand story from a European perspective is it means we don't expect a spike in gas prices.
Yeah, exactly. We are watching if there are any signs of increasing industrial activity in China, if demand for gas will rise. And China is also well supplied by pipeline flows from Central Asia and from Russia, and on the coal supply. So demand for LNG is yet to be seen, but at the same time, we shouldn't forget that Chinese consumption in the winter is quite high, so it also depends on how cold the winter is in China. So we'll continue to watch for signs of economic recovery in China, as well as going forward into the winter, how cold the temperatures will get.
Okay, thank you very much. Thanks for that, Anna. Thanks for joining us. Anna Shiraevska with the latest on the gas story. Let me just get to some breaking news coming through, and we have some news coming through on Iran. So I will get some details on that for you. Iran Foreign Ministry spokesman, this is Nasser Kanani, speaking in Tehran, saying that Iran says that US prisoners are to be released within an agreed timeline. So an ongoing story we're watching there when it comes to Iran. Let me just get to some stories coming out of China as well. We've mentioned the weakness in the property sector. This one relates to the wealth manager that we have been mentioning, some weakness in that particular business. China's banking regulator has set up a task force to examine the risks surrounding one particular wealth manager, the nation's top private wealth manager, in fact, after that unit missed payments on multiple high-yield investment products. So this was one of a number of news lines that came through over the weekend concerning China that has weighed on sentiment. So this is in connection with this one wealth manager in China. Coming up on the program, we'll get back to FX markets. The yen slides towards intervention territory as the Japan-US yield gap widens. More next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
This is Markets Today, 52 minutes into your Monday trading session here on European stocks. And European equity markets going nowhere in a hurry. The FTSE underperforms, the Xetra DAX doing a little better, up by 0.2%. Let's talk about what's happening in these markets, and specifically FX, actually. Let's start there. Ven Ram joins us from the Markets Live team and can give us his thoughts on the Japanese question. Will they or will they not intervene, Ven? That seems to be one of the questions I've returned to work to this morning. We were talking about this over recent weeks, but we went through 145. Some people say that's significant. Others say it's actually not the level that matters. It's the volatility and the pace of change. What are you watching for when it comes to dollar yen?
The key driver of the dollar yen at this point is real rate differentials. If you look at the 5-year real rate in the US, we've got 2%. And if you look at the real rate in Japan, we've got minus 1% almost. So that's a huge that's a huge incentive for investors to sell the yen and buy the dollar. And it doesn't help that the BOJ is looking to condone inflation. As long as the BOJ's attitude remains to condone inflation, it's going to be the story that the yen is going to weaken further and further. It doesn't help also that currency volatility in general is pretty low these days. That means that yen as a funding currency is still very much in vogue, and that's why we have seen the yen on the back foot.
Okay, and so you see drivers then for dollar yen. I guess you see drivers that come from assumptions about BOJ policy, but also assessments of what Treasury yields do from here. Are we likely to see any change in BOJ policy then?
Sorry, I can't hear you.
I do apologise. Ven Ram from our Markets Live team, struggling to hear us there over in Dubai. Thank you for bringing us your thoughts this morning. But we got his thoughts on the yen, so that's something. So that's what we've got from Ven this morning, talking about where we go on dollar yen. We went through 145, as I mentioned earlier on, currently trading at 144.81. Let us get to what we've got on the markets. We'll get a quick check on the GMM for you, which can take us through where we are on stocks. Actually, an improving picture in terms of sentiment. So we talked there about the Japanese news lines. We've also had plenty out of China, of course. They're setting up a task force to investigate what's going on with this wealth manager that has not been paying out to investors. There's also been plenty of news surrounding the property sector. All that has weighed on Asian markets. We saw the MSCI Asia Pacific down by 1.2%. We saw the Hang Seng down by 1.7%. All of that has been weighing on markets, but actually it hasn't weighed too much on what's been going on in Europe so far. So European equity markets actually bouncing a little this morning. Broadly, we see the FTSE is underperforming, but elsewhere, markets recovering quite quickly. So Xetra DAX up by 0.4%. On FX markets, interesting that our colleague Mark Udmore pointed us towards the movement in the ruble, which for some reason isn't showing up on the screen you're looking at there. But if we look at G20, we can see that there's movement in the ruble, going through that 100 rubles to the dollar mark, which is of interest. He told me a little bit earlier on. Also watching on what's going on, that's on the FX side of things. We've seen the FX markets we've seen the dollar gaining actually earlier on today, but now we see it fairly flat. So interesting to see a bit of an unwind there, a bit of an unwind in some of the moves higher that we've seen in Treasury yields as well. So Treasury yields have been moving higher. We've seen the dollar going higher. Now we see both of those trends pairing just a little. The 2-year yield currently standing at 4.89%, the 10-year at 4.15. Interesting to look at commodities as well, standing out on the GMM as well. Natural gas prices in Europe and the UK moving higher. 36 euros a megawatt hour, though certainly on the European benchmark is not the above 42 that we saw last week on the back of those lines out of Australia that our colleague from the natural gas team, Anna, was talking about a little bit earlier on. So we've got a little bit of respite there perhaps from those relatively elevated levels, and certainly not levels that we saw last week. And of course, iron ore prices a little bit weaker. We should tell you what's going on with Phillips, as we've seen an investor taking a stake there in that particular business. Our colleague Joe Easton took us through that a little bit earlier on. Phillips gaining then after Agnelli's Exor business has taken a 15% stake in that company. The health tech business, apparently something that the Agnelli Exor vehicle run by John Elkann can get excited about. That is it for markets today. We will leave you with further analysis of these markets. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. Also, happy Monday. I'm Francine Lacqua here in London with the conversations that matter, and here is what coming up on today's program. Rising concerns over China's recovery as the crisis deepens at property developer Country Garden, plus alarm bells ring in the country's shadow banking sector. Goldman predicts the Fed will start lowering interest rates by the end of next June with a gradually quarterly pace of reductions from there on. Plus, the yen weakens through a key level against the dollar, hitting a 9-month low as traders watch for any signs of intervention by officials in Tokyo. So let's take a look at the European markets map. This is what markets are telling us across the board. So you see there's a bit of a tentativeness out there in Europe, but really the big story is on Treasury yields. So let's get up to those. They're edging up towards levels last seen in November. Again, this is on speculation that the Federal Reserve will keep interest rates in restrictive territory and disappoint investors hoping for easier policy. Let me remind you that later this week, the focus will be on the minutes, also from the Fed's latest policy meeting. As always, traders will try and figure out clues on the central bank's next move. Then the other key story, and it's actually our big number for today, is the level of yen. This is something that we've been focusing on quite a lot. It's now steady after breaching its year-high level of 145.07 versus the dollar. Again, investors starting to monitor that level for any signs that the government may intervene as it did last year. Then we, of course, spend a big amount of time today talking about China. Shares of Country Garden closed sharply lower in Hong Kong after it halted trading of some of its bonds. Just half an hour ago, the developer also said it's now looking to pay maturing yuan bonds that are due on September 2nd over a 3-year period. The looming crisis in the Chinese property sector is weighing down the country's economic recovery. In fact, investors are also watching for official figures due tomorrow on industrial output, retail sales, and fixed asset investment. So let's bring in our panel of experts to talk China. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, and Bloomberg's Sofia Orta-Acosta, who for many years lived in Asia. So thank you both for joining us. Sofia, I feel like every day there's concerning news about China, and if you look at the evidence, there's nothing really to point to a better trend.
Yes, exactly, Francine. And the problem is there's a crisis of confidence, and that's the one thing that Beijing can't seem to solve. Last week, we had confirmation that China's in deflation. Now we have the property market again resurfacing risks, not just in the property market itself. You mentioned Country Garden in the intro, but also for the broader financial industry. I mean, if you look at the trust fund industry, many people don't actually understand what that is, but it's a huge amount of capital. It's essentially what China does. These trust funds pool household household wealth. It's about $3 billion in size, and then invest in riskier assets to kind of generate high yield returns. So the fact that you have this crisis of confidence in onshore China is really rippling through the market, and that's not going to help with tomorrow's data either.
So, Patrick, do you think it's much worse than we were expecting, or we're just optimistic because they suddenly reopened after COVID and we thought it would follow the template of here in Europe or the US?
That's what I thought. In January, I actually actively changed my portfolio to position from a reopening of China, and it has been a string of disappointments since February. So you've got issues with credit, you've got issues with property, and that flows through into consumer confidence. And yeah, it's been month after month of misses and negative news.
But is this because there are structural problems that we hadn't really quite seen that were maybe masked because of COVID?
I think that's fair to say, and China tightened with everyone else, and now they're actively loosening, trying to stimulate the economy. And it's hard to put your finger on what's really driving it, but it comes back to credit, property, and consumer confidence, I think.
Sophia, I mean, markets have been expecting, right, policymakers to do something in China, and it hasn't quite been the bazooka that they were expecting. Is because that's limited in terms of scope and what it can do, or because they just don't want to yet?
It's both, really. You know, and I think the credit data last week, I was on holiday, so I was just checking it on my phone. Oh no, another set of bad data out of China. You know, banks are they're trying to extend credit. Credit is incredibly cheap. The central bank has reduced interest rates. They're unlikely to do so tomorrow. It's a monthly operation where it has the window to do so because it's already so cheap and nobody wants credit. I mean, it's the issue that Patrick's talking about. There's the demand issue is really, really acute right now in China, and everything that policymakers can do or want to do or willing to do has to do with the supply side when it comes to stimulus. And that's really the issue here. The policy transmission is not working. You have a confidence crisis. You have the property market where the majority of household wealth is still invested in the property market. So you're unlikely to get people spending. You have an enormous amount of savings that are not being deployed. I'd like to ask Patrick, you know, when you're looking kind of outside from the region, from here, and you're looking for evidence that China's economic recovery is working, which data point do you look at?
I don't think you can find that data point. The one area I'm reasonably confident in is on Macau and the gaming revenues, all of that. So traveling in mainland China out to Macau again, gaming revenues looks good. But overall, for the aggregate economy, I don't think there's something you can put your finger on because it's not there.
So, Patrick, what does it mean for how are you invested in China right now? Did you cut your exposure, or are you waiting a bit longer?
I don't have much exposure. I do have two equities. I've got Alibaba and I've got Las Vegas Sands, which is the play on Macau. So I don't have a significant exposure. It's something that I'm not actively looking to add. I'm short China Vanke, which is a Hong Kong property developer, real estate marketer. But yeah, I've got some longs offset by some shorts, and I'm pretty comfortable right there.
Is there anything that's looking good in the Chinese economy? A sector that's being either supported? I know we have serious concerns about shadow banking, but frankly, that's not something that's only a worry in China.
Yeah, exactly. I mean, and shadow banking has been a worry in China for a number of years. I mean, I do think, you know, when sentiment is this bad, and when there's this kind of crisis of confidence, that does keep. It tends to spiral downwards very, very quickly. You saw the reaction in markets today. I mean, European markets are fine, right? Nobody's kind of expecting China to collapse. So the crisis of confidence, I think, is very localized right now, which is a positive. People were panicking a little bit more about that globally at the start of the year. So I think that's the positive story there. But again, China has a lot of tools at its disposal. It's just choosing not to use them. And I think a lot of people forget also that the property crisis was engineered by Beijing. This is something that China needed to do to diffuse risks in the financial system. It's perhaps not working, or it's more severe than policymakers had expected, and you're not seeing that recovery story come through. But things will take time. Things in China take a lot more time. So I think, you know, I think when confidence is this low, the risk of upside news is very, very high.
Patrick, what does this mean for the rest of global markets? So you could be importing deflation, which is probably welcome from central banks, or it could upend everything.
It's a bit of both. Basically, if you look at PPI surveys, basically manufactured goods coming out of China aren't rising in prices anymore. China's still probably going to grow at 4% this year, so it's still going to outstrip the developed world, but that's probably well below what the 6% people were looking for earlier in the year. So it's like the rest of the world, where things aren't completely terrible, but they're not good either.
But who would actually lose the most? Europe?
Europe and America still are big importers from China, but their economies aren't particularly strong. Consumers relatively robust, but you have seen lessening purchasing power in the West as well, and that impacts China as well on the manufacturing and on the demand side of things. I don't think there's much benefit, but there's not a massive collapse you have to be worried about unless you are exposed to Chinese property, in my opinion.
Patrick, does it change your exposure to some of the industries? We've talked a lot about luxury, but also some of the other things that maybe are less immune to other sectors because of the China exposure.
Yeah, so I own Hermes. At the start of the year, I owned LVMH and Hermes. We've sold LVMH now, and the weakness in demand there has really been driven by the U.S. much more than China. The high-end affluent consumer still has a lot of purchasing power. They're traveling, so they're still purchasing the high-end goods, but it's actually the U.S. high-end consumer that's probably a bit of a headwind for that sector.
And Sophia, if you look at commodities and some of the things that we normally associate with China, are they still building and are they still using infrastructure, or do you worry about Australia and some of the commodities that are exported to China?
Yeah, I think the commodities market was, like many of us, like Patrick was saying, expecting that kind of reopening boost. So it kind of front ran that reopening boost that we never got, the pickup in demand within China, and the expectation that China, after that, when demand didn't come through, that China would kind of throw stimulus at its economy, and that would come in the form of infrastructure spending, building roads, building bridges, the kind of old playbook of Beijing. That's also not coming through. So I think the risk there is, not just Chinese demand, but global demand is weakening, and you're not going to get the kind of pick up in building and infrastructure that we've seen in the past. So there are headwinds to the commodities market there. But, has that been priced in? I think much of it has. It's been a really kind of whirlwind year of trading for any kind of China demand exposed market. Industry, the luxury industry was also a major way to play that story, because I think people like Patrick, and correct me if I'm wrong, don't really want to have direct exposure to China and prefer to kind of play it through other sectors. So
yeah, it's also quite hard actually, unless you're fully invested in China. Thank you both for joining us. Bloomberg Sophia Orteig-Costa and Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, stays with us. Now, there is one stock we also need to watch out for. That's U.S. Steel. It's begun a formal review of strategic alternatives after receiving multiple unsolicited proposals. Now, we also understand that actually in the last day or so, United Steel has rejected a takeover offer from Cleveland-Cliffs, but the offer represented a 43% premium to steelmakers' last close, which is why we're now seeing a big bump pre-market, gaining some 22% for U.S. Steel. We'll have plenty more, of course, on this company and others coming up. Goldman Sachs economists also anticipate the Federal Reserve will start lowering interest rates by the end of June. We'll discuss that next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Tuesday, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the country.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, we also had breaking news this morning about the Agnelli family holding company called Exor buying a 15% stake in Philips for around $2.8 billion. Now, we understand what they're most interested in is actually some of the healthcare things that Philips does. And you can see that stock price getting some 4.6%. Now, for more on this, we're with Patrick Armstrong. He's Chief Investment Officer at Doremi. Patrick, thank you so much for sticking around. Now, when you look, of course, at some of these, the stocks that are being, seen as attractive, like Philips is a bit of a jumble in terms of exactly what it does. Do you like healthcare?
The healthcare part of Philips, you can see that's what's attractive. So from their last earnings statements, their healthcare bit of the business was growing double digits, I think 12% from memory, while the overall business was growing at 3%. So a focus on the higher growth, higher margin, moving away from consumer electronics probably does lead into a higher multiple that would be warranted if it does shift focus in that direction, and that does sound like the plan.
Patrick, in general, these things, again, Philips has seen significant pressure because of some of the valuations and, investors testing some of the limits there. With someone like Exor that has quite a good reputation making good investments, I don't know whether you'd call them the Warren Buffett of Europe, but does it change the fortunes of a company like this?
It's a vote of confidence anyway. It's investors who don't have time to do deep due diligence are trusting that Exor has done the job for them. They see value and probably going to prompt extracting some of that value by helping management refocus on moving away from commoditized goods where you can't demand a significant profit margin into something where Philips probably can demand a significant profit margin.
I know, again, and there's still many concerns about, the costly recall of some of the sleep apnea devices, but do you own Philips?
I don't have any position on it.
Is there anything in that kind of space that you like, or again, it seems a bit more risky because it depends on trials and you just...
Yeah, I don't have any medical equipment companies right now. Valuation is much higher for the Thermo Fishers, those kind of stocks in America. So I think that's what Philips will be envisaging that they'll be able to get towards. But I've got more pharmaceuticals in the healthcare companies. I like the cash flow and the multiples they trade at, whereas the medical equipment companies are a little bit rich for me.
Okay, I have my morning must-read, Patrick, and only you can answer this because it's a fun but also actually quite sad read. It's by Andrea Felsted. She writes great pieces, usually on luxury, and today she asks, look, puppies and Patek Philippe's have had it tough since COVID, and she says, look, both were highly sought after during lockdown. Demand has not recovered in the post-pandemic economy. So I'm not asking you whether you'd buy a puppy or a Patek, because I'm sure you'd buy both. But Patrick, again, are we underestimating when you look at travel and some of these, big impulse buying? Is it still a legacy of COVID? Do you trust the economy we're living through now?
Actually, at the start of the year, I love luxury companies because I didn't trust the economy. I didn't trust the mass market consumer, but that's actually been one area of resilience, that you've got a fully employed consumer in the US, pretty fully employed in Europe, and the spending power there has been pretty resilient. So I was trying to hide away from the mass market, move into the high end. And I don't think the high end is incredibly disappointed. I think it is definitely showing signs of softening. But mass market consumption's been pretty reasonable, and that's why I've lightened up on my luxury companies. But as I said, I still own Hermes.
Anything in pets?
I've got a company called Zoetis, which is a healthcare company, but it's healthcare for animals. So it does livestock, but it does pet insurance, it does dog and cat medicines and treatments, and that's going from strength to strength, particularly on the pet side of the business. So people are taking care of their pets.
Okay, I'm like your customer. I mean, I basically bought Peak Market, my puppy, but he's worth every single penny. We have to talk more about Andrea Feltzer's piece. Just read it, because it's fun, but also a little bit sad, actually, for some of the pets to just go into OPIN, go on your Bloomberg terminal. And good news, maybe for Patrick and others, the UK pet market has stabilized. We can't only talk about puppies and nice watches. The Fed, are you expecting cuts next year?
It's too hard to say until something shocks the employment situation, and it's not going to be Fed hikes anymore. So maybe the lagged impact of the Fed hikes provokes a recession and pick up in unemployment. And the Fed's forecasts actually say they do expect unemployment to rise, but they actually expect continued economics. Well, I don't even know if I want to call it strength, but no recession anyway. So I'm not sure when the cuts will happen. I don't think there's going to be another hike, and I think the Fed may be sitting on its hands for a very long time. They've acknowledged that they are in restrictive territory already. So if you do see inflation getting down to their targets, it would be consistent to have a few marginal cuts to get down to neutral.
All right, Patrick, thank you so much, as always, for all of your insight. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, stays with us, and we'll talk currencies and yen shortly. We'll talk about the yen weakening to a level that may be prompting intervention by authorities in Tokyo. That's next, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupied areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now let's talk yen, the currency touching the weakest in 9 months. That's as Japan's interest rate gap with the U.S. pushes the yen towards levels that saw authorities intervene. Now for more on this, though, with us, Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, wow, I'm so glad. I mean, you're probably glad you're not BOJ governor right now.
Yeah, well, if I was BOJ governor, I would be getting rid of yield curve control pretty quickly because it's just a disconnect that's not going to work. When you've got every other central bank hiking rates up at 5%, real rates at 2.5% in different term structure in the United States, and you've got Japan with significantly negative real yields. The rest of the world's moved on from that. It's an untenable situation that you're going to have yield curve control and support the yen. So they're going to have to decide which one's going to break. I think they want to do this in a gradual phased manner, but I do think yield curve control will be gradually phased out.
Yeah, so I was going to ask you, this is not a question of if, right? It's a question of when.
It has to be, yeah. Unless the world changes and we go into a deep recession where the rest of the world gets into cutting interest rates towards zero again, you can't have negative real yields and capping things at 1%. The Bank of Japan already owns 51% of all Japanese bonds issued right now. So there comes a point where they're the only purchaser.
This is our big number of today. It's basically just level of yen. So it's big because we're just on government watch on whether to see whether the policymakers intervene. So it's 105.07. Does this change how you invest in Japan at all?
Yen can really strengthen if the Bank of Japan does show a plan to get rid of yield curve control. But while it's in place, I think the yen just has to consistently weaken. So we don't have a short yen on right now, but I've got a significant short in 10-year Japanese bonds right now. So if you put them both on, you're just expecting that policy to continue until it breaks. But when it does break, I don't want to be short yen. So I've decided to play it through the bonds, which I think is a safer bet.
So you're not playing any of the companies in Japan?
I've got some companies in Japan, but it's not driven so much by what the Bank of Japan's doing. It's driven by valuations. I've got an industrial company, Mitsubishi, in Japan, which is based on valuation and pretty reasonable margins there. So it's not driven by the Bank of Japan.
Overall, what's your favorite stock right now?
I think it may be Zoetis. It's had a really good run, so we talked about that in the pet care. That's just a stock that's continuing to grow. The estimates getting revised higher. So unfortunately, all the stocks that have done really well this year are now getting to pretty expensive multiples, and Zoetis is getting into the high 20s on earnings. But that's a stock. I like the business maybe more than the stock at 190.
All right, Patrick, thanks so much. Patrick Armstrong there, Chief Investment Officer at Plurimi Wealth. Coming up, Bill Gross says stock and bond markets are overvalued and bullish investors have got it wrong. We get the PIMCO founder's outlook on rates and inflation. That's next, and this is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
On the next episode of The Circuit.
What motivates me is I want to use this technology to truly do what I think at least all of us are in tech for, which is democratizing access to it.
There are major downsides we have to manage to be able to get the upsides.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Rising concerns over China's recovery as the crisis deepens at property developer Country Garden, plus alarm bells ring in the country's shadow banking sector. Goldman predicts the Fed will start lowering interest rates by the end of next June, with a gradual quarterly pace of reductions from there on. Plus, the yen weakens through a key level against the dollar, hitting a 9-month low as traders watch for any signs of intervention by officials in Tokyo. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Let's have a look at what U.S. Steel is doing, beginning a formal review of strategic alternatives after receiving multiple unsolicited proposals. Now, if you look at what we've heard from them, they've rejected this approach as being unreasonable, but that approach was actually a 43% premium to the steelmakers' last close, which is why pre-market we're actually seeing U.S. Steel gaining some 21%. Now, again, this is an icon of American industry with roots stretching back over a century. And yesterday is when they had this cash and share bid, which values the company about $7.25 billion based on the closing price on Friday, which was a 43% premium. Now, the PIMCO founder and former chief investment officer, Bill Gross, says both stock and bond markets are overvalued and bullish investors have just got it wrong. Well, he spoke to Bloomberg about his outlook for markets and inflation.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. But I do think that the 10-year at 4.15 now, you know, it is probably overvalued and has been overvalued for a long time in terms of a lower yield and too high a price. You know, if Fed funds actually came down to 2.5% or 3%. You know, the 10-year term premium, that is the spread between 10 years and Fed funds, typically has been about 135 basis points over a long period of time. So, you know, if you add 135 basis points to 2.5% or even 3% on Fed funds, you get to a point where we are now. And that suggests that all of the bulls on treasuries and on the 10-year and maybe even on the long bond, I think their arguments are a little misplaced. I think it's been overvalued for a long time, and we're going back to proper valuation on longer-term notes and bonds.
But I mean, you understand better than anybody that relationship between what's going on with inflation and the Fed and how that sort of factors into some of these bullish calls. And those bull calls have really started to increase, not just because of the two reports that we got this week, Bill. If they do have it wrong here, kind of give us a sense here of why specifically.
Well, I think they got it wrong, first of all, because rates were so low because of quantitative easing and the fact that, you know, in some cases, the 5-year real yield was a minus 200 basis points, which sounds incredible, but it was a year and a half ago and is now a plus 200 basis points, so a 400 basis point switch in terms of real rates. So I think investors simply got overwhelmed with the fact that the Fed would stay low and stay low for a long time, and that inflation wouldn't pop its head out of the out of the rabbit hole, it has, and so now we're moving back into an old age world, I suppose, in which interest rates really are a sign of a healthy economy. And the way we have it now, the negative yield curve, and we've had that for 12 to 18 months, I suppose. A thriving economy, a thriving finance-based economy can't do well. Doesn't mean it goes down in the dust, but it can't do well if low-risk investments yield more than high-risk investments. And as you march out from the 30-day bill to the 30-year bond, you can see that you are better off yield-wise in terms of the 30-year bill or 30-day bill, and so that's just a perverted yield curve, and it won't do well for the economy going forward.
Well, that's the PIMCO co-founder Bill Gross. Now, that comes as economists at Goldman Sachs predict that the Federal Reserve will start lowering interest rates by the end of next June. The Wall Street Bank actually anticipates 25 basis point cuts per quarter, but expects no more hikes to come this year. Now, for more, we're joined by Bloomberg's Christine Aquino. Christine, treasuries are so interesting right now. What are you looking out for next?
Yeah, Francine, I mean, there's a big debate really that's brewing over the path of long end yields. I mean, Bill Gross is weighing in on that. And essentially, there is this consensus saying that I think there is this time now where longer end yields have been so low for a while. They're getting back to those more normal levels that we've seen over longer stretches of time. And, that term premium increase, which Bill Gross was alluding to, that's exactly what we're seeing now, right? Because the latest kind of ructions in the treasury market that's really been led by 10 and 30-year yields. That's what has driven the yield curve steepening. And remember, this yield curve steepening is essentially what a lot of the perpetrators of the yield curve theory are really fearful of, right? It's really not kind of the yield curve inversion that people should be afraid of. They say that it's the steepening that follows afterwards, and that's exactly what we're seeing now. And yeah, it really just seems like a process of longer end yields adjusting to the new reality of higher rates, perhaps higher inflation.
But so I know there was a big school of thought actually saying, look, well, we're seeing a soft landing, and now it seems a bit more touch and go. When do we know what kind of economy we're left with?
Yeah, that is the big question, isn't it, Francine? And I think the problem with kind of determining the timing for the soft landing is, of course, all the policy lags that we're experiencing at the moment. Economists have estimated it's about a 2-quarter lag until we actually see the effects of whatever the Fed is doing at the moment. And we've kind of seen that with the way that inflation has kind of come down from the peaks that we saw last summer, right? But it took a little bit of time and a lot of kind of consistent messaging from the Fed to really get it below those very, very high levels. We're not a target yet at the moment, but we are now seeing the Fed kind of starting to shift its message to more of data dependence. And so, yeah, it is quite a tricky balance for them. And they could be in a situation where, a soft landing for a little bit could potentially very easily shift into something that's a little bit harder.
I mean, there's a brilliant quick take actually looking also at whether the Fed has ever accomplished this. And they said maybe arguably once in 1994 under Alan Greenspan. If you look at China, and this is the big structural concern or something ugly happening in China because of the data points we're getting, how does that impact Fed thinking?
Well, I mean, it's very much a big factor, Francine. Of course, they would say that, oh, they're not kind of making policy for anyone else in the rest of the world. They're just really looking at the U.S. But China's very much a big factor in that, right? Because, again, remember, China was meant to be this big positive growth story for the world economy at the start of 2023. It really isn't panning out. In fact, we're kind of going the other way. And now kind of issues in the property sector piling so much pressure on the Chinese government to deliver that stimulus. I mean, this is something, of course, that the Fed is probably going to want to be keeping an eye on because it will have such big implications for the world economy and therefore, how the U.S. moves forward from here.
Yeah, and of course, from that stems everything from, ECB policy to possibly BOJ. This is the other interesting one.
Yeah, absolutely, Francine. And yeah, it really creates a problem for some of these central banks that have been laggards in the policy tightening process, right? Because again, I mean, we've heard from Christine Lagarde and her colleagues over the summer. They're kind of shifting more into this data dependence mode, much like the Fed. And so I think the argument is that there's very limited time for the ECB to kind of deliver more rate hikes down the pipeline. I think the expectation is that they're going to deliver one more in September and then potentially follow the Fed and kind of doing that extended pause, because again, it's very hard for smaller central banks to go it alone when some of your bigger counterparts are kind of rethinking their next steps.
And this kind of changes everything. I mean, if you look at yield curve control for Bank of Japan, I guess it's a question of when they stop it. And you know, if you look at traders, they're a little bit all over the place on that.
Yeah, absolutely, Francine. Because again, we've gotten so many mixed messages from the Bank of Japan. I mean, they did tweak that policy, but then very much immediately after, in the next week, right, they kind of stepped into the market to kind of control that rise in yields in reaction to their initial action. And so there's very much a sense in the Bank of Japan corner that, you know, they really don't like this rapid rise in yields. And even though they've kind of taken the baby step toward normalization, they really don't want to see that process unfold very rapidly.
Christine, thank you so much. Christina Quito there from our MLive team looking at some of the big market moves. Now, coming up, gas supply risks are mounting as Europe heads towards autumn. We'll discuss the outlook next, and this is Bloomberg.
Really don't like this rapid rise.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
In Hanover, if you're caught watering your lawn on a hot day, you can get a fine of 50,000 euros. Germany is adjusting to levels of heat it's simply unprepared for. Only 1 in 10 Germans has an air conditioner versus about 9 out of 10 households in the US. Last year, more than 8,000 people died in Germany due to excess heat. That's the third highest in all of Europe. The health ministry has rolled out its first ever heat protection plan, hoping to save thousands of lives every year. But it's vague, and execution, as ever, is a complex issue in Germany. The heat weighs on growth, too. According to early research from Allianz, the heat wave this year may have shaved 0.6% off of global GDP. Why? Simply because people work more slowly, work less, and make more mistakes when it's hotter out. In Germany, if winter was about rationing gas, summer, increasingly, is about rationing water.
Bloomberg's Oliver Crook there looking at the impact of extreme heat in Germany. Now, gas supply for the winter months in the Northern Hemisphere is also at risk, with a potential strike by workers in Australia putting LNG shipments at risk. Let's go straight to our Bloomberg natural gas reporter, Anna Shiravaskaya. Anna, great to have you on the program. Look, this is a huge, huge deal. If you look at the current prospects for industrial action in Australia LNG facilities, how disruptive could that be for the rest of the world?
At the moment, we still don't know if the strike will go ahead. The next round of talk is scheduled for tomorrow. But if the industrial action does happen, it risks disrupting about 10% of global LNG supply. And while most of the customers for that Australian supply are in Asia, China, Japan, Thailand, Taiwan, if there is an intense competition for cargoes, for available supply, that risks raising prices in both basins, in the Pacific and in the Atlantic, and Europe and Asia will, as a result, compete for available supply.
So, Anna, what are some of the other factors actually worrying the LNG market?
The attention is at the U.S. hurricane season. If there's any disruption to the Gulf Coast facilities, that could also, it happened in the past, so it could also disrupt global supply at the time when the Northern Hemisphere is approaching, slowly but approaching the peak winter heating season demand. So attention will be on that disruption. And also there are some planned outages globally, such as in Russia, Trinidad, and actually more plants are going to be out for plant maintenance in Australia, and Egypt is curtailing its exports because of high domestic demand amid high temperatures.
I mean, that's a great wonder, but a little bit worrying, right? That you could have all of these like different points of tension everywhere in the world. Will it show up in bills for consumers?
Indeed, yeah, it's a global market. That's why effects around the world affect both regions. At the moment, prices in Europe are still much lower than they were at the peak last year, but still consumer bills are still elevated, resulting from that increased levels we saw last year, so both for households and industrial consumers. So if the current uptick in prices stays and there's actual disruption in supplies, there could be extreme market volatility and further price spikes, which could in the future translate into customer bills. So we're going to watch how long this market volatility lasts.
And you do some great reporting on how much do you have to look at the weather as well? Last year, we were definitely helped by this mild winter weather. Is it too early to find out what happens the next couple of months?
It's a bit too early to say. I think going into the autumn, we're going to watch forecasts for the winter. But if winter is cold in both Asia and Europe, that would result in elevated prices in both regions. So again, competition for LNG could be very intense this winter.
Yeah, you're going to be very busy in the winter. Thank you so much, our Bloomberg natural gas reporter, Anna Shiravaskaya. Coming up, as we lead up to the BRICS Leaders Summit in South Africa next week, we also discuss what to expect. We're live in Johannesburg next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, Argentinian Congressman Javier Milei is leading a crucial primary vote in a performance set to upend October's presidential race. Bloomberg's Manuela Tobias has the details.
Argentina witnessed an absolute upset on Sunday night's primary presidential election. Javier Milei, an outsider third-party libertarian candidate, took 30% of the votes, winning as the highest voted candidate in the race. He outpaced the opposition coalition, who had, two candidates competing for the nomination, and the incumbent party as well. He outscored everything that the polls were expecting, which were pegging him at around 20%, no more. And it is just an absolute surprise compared with, as well, what markets were expecting. Milei has been compared with Donald Trump and Jair Bolsonaro. He represents his own libertarian party. Within all of the different market scenarios, a Milei upset was the least desired by markets, so this is likely to be received with fear. Investors like his economic message of slashing public spending, but he has an aggressive style and lacks any sort of party structure that would allow him to get the changes that he needs to make in Congress, over the finish line. He also, we're expecting a sell-off, definitely in the parallel exchange rate that analysts say could be around 15-17%. We're also expecting bonds to drop lower on continued uncertainty and the expectation that this election could go to a second round. We have a general election in October, and that could go off to November now that this race has been divided in 3 parts. Manuela Tobias, Bloomberg News in Buenos Aires.
Well, that was Bloomberg's Argentina economy and government reporter Manuela Tobias. Now, South Africa's BRICS ambassador Anil Suklal says the group aims to promote the interests of the developing world and is not in competition with any other bloc. The BRICS nations will meet for their annual summit next week in Johannesburg. So for a full roundup of what's expected, let's get straight to our very own Jennifer Zabazaja. Jen, good morning. So what else did Suklal actually say?
Yeah, Fran, I mean, this is significant. Suklal has been a longtime diplomat here in South Africa. He is the Sherpa this year as South Africa is the chair of the BRICS Summit. So we're really looking forward to what he was going to say. What he said specifically, and what he started his comments today, was about what you just mentioned, that he said it was unfortunate that the narrative has really shifted, that BRICS is trying to replace any sort of bloc or is anti-Western. He actually did say South Africa does not have enemies, and really this idea of supporting the Global South and giving the Global South more of an opportunity to have a voice and a seat at the table in some of these multilateral institutions is something that these countries have not had before. And he thinks it is time. And speaking specifically about expansion, because that is something we've been talking a lot about. Right there, you're seeing old video of the 5 leaders that had encompassed BRICS. Right now, there's still 5 leaders, but as we've reported, more than 24 countries have actually formally applied to be a part of BRICS. And what Suklal is saying is that they still haven't really zeroed in on what the guidelines are going to be for which countries will be added. And that is really the focus for him and the other Sherpas and sous Sherpas, because they are meant to prepare a report that will then be given to the heads of state to decide which countries will be added. And so he thinks that there may be some pronouncement next week, but what he did here in the guidelines that he was given by his foreign ministers and others was not to make this expansion an accelerated process. And so those were just a few of the comments that he is making here in our office today.
So, Jen, you also spoke to the chair of the BRICS Business Council, Bouzy Mabouza, earlier this morning. What did he tell you?
Yeah, Bouzy is the chair of the BRICS Business Council. This is the 10th year of the BRICS Business Council. So she talked a little bit about the significance of why this exists and what the benefit is, not just for South Africa, but for Africa as a whole with other BRICS nations. Take a listen.
We have trade economic ties and agreements with Europe, with the US. The BRICS formation is not a trade agreement of any sort. It is a club of nations that have the same outlook in terms of how the world should look in terms of multilateral cooperation.
Do they though? I mean, we're talking about Russia, India, China, South. I mean, they have very varied interests in terms of what the global, the global economy should look like and who should be superpowers, right?
Absolutely. Look, there may be differences, but the fact that the BRICS emerged from global South-South cooperation and an effort to ensure that we move hand in glove and support each other as we emerge, and these are emerging economies, of course, that have the ambition to grow their respective economies. China seems to be realizing that better than most. India has done fabulously well over the past few years. There are lessons there. There are opportunities for us to, in partnership, lift each other as we rise. So there may be differences here and there, but the fact that these nations do believe in a multipolar world, I believe, is a good foundation for the engagements that we are having.
Yeah, so Fran, Bouzy there saying that the importance of South Africa and the rest of Africa's relationship with the West, with the EU and the US is of course important, but the goal here, at least with the Business Council, is to enhance the benefits that Africa gets in terms of trade and investment opportunities. We saw last week here in Johannesburg, the Chinese ambassador and the South African ambassador to China making a number of announcements about specific deals with China and South Africa. And so what Bouzy wanted to reiterate is that is what is of importance here, despite what the other rhetoric is at this point in time. And so the fair, the Business Council fair will be over the weekend. So we're hopefully expecting to see some more investment deals and intra-BRICS trade announcements announced.
Jennifer, thanks so much. Jennifer Zabazauja, their Africa correspondent, reporting from Johannesburg. Now, we're also keeping an eye on what's happening to U.S. Steel. Again, it started a review. It spurned a $7.25 billion bid. This means the offer actually represented a 43% premium to the steelmaker's last close on Friday. Pre-market 23% higher for U.S. Steel. Up next, Bloomberg Surveillance Early Edition.
half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load and responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 5 a.m. in New York, 10 a.m. in London, and 5 p.m. in Hong Kong. Our top stories today. China sets up a task force to examine risks and potential debt after one of the nation's top private wealth managers missed payments on multiple investment products, alarming investors with fresh anxiety about the health of the shadow banking industry. Goldman Sachs pencils in the first Fed rate cut. Economists are anticipating the central bank will start lowering interest rates by the end of next June with a gradual quarterly pace of reductions. We're going to dive into what that means for the market shortly. And U.S. Steel rejects a $7 billion takeover offer from rival Cleveland-Cliffs. It promised to create one of the world's biggest steel makers, but U.S. Steel calling the bid, quote, unreasonable. Welcome to Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Danny Berger is off today, a well-deserved vacation. Let's get a quick check on these markets, though, because a really interesting dynamic playing out on this summer Monday, we'll call it. Let's start over in Asia, essentially what happened overnight, because you are seeing a broad sell-off in the Asia-Pacific region, to the point that you see the MSCI Asia-Pac index down about 1.2%. But the real underperformer here is going to be China, and you can already see that in the Hang Seng Index, down about 1.6%. This is an index that just won't catch a break. What's important to note about this is it's really affecting sentiment around the world. So if you actually look at the S&P 500 or the European stock 600, excuse me, it actually kind of mirrors the sentiment you are seeing in China. Now, of course, it is seen as the alternative when you don't have that much of a bid into the Chinese market. But trend-wise, you are still seeing the same thing in the global equity indexes. Let's get to the currency market, though, because dollar-yen actually retreating a little bit. It hit a 9-month low of 145 on that currency pair. Continued weakness for the Japanese yen as we again talk about simply what the BOJ can do, whether they can really deal with those inflationary pressures, which, to be fair, they've actually been wanting for the past, couple of decades. Interesting dynamic there. Nevertheless, dollar yen 144.93, kind of unchanged on the mark, but again, pulling back from that key level of 145. Let's look at copper, though, because, again, we are seeing red on the screen, but not by much. 371 on those copper futures. What's interesting to keep in mind is that overnight, even as a lot of Asia was selling off, copper was actually higher. And that's an interesting trade, given the kind of cross-asset dynamics there. Let's go from Asia over to Europe, because, again, speaking of that dynamic, here's where you see the divergence. Stocks Europe 600 up by 0.2%. So that Chinese sentiment not really playing as much into the European story. A real outperformer there is going to be that German index, the DAX, higher by about 0.5%, we'll call it. But even the Boon market getting a little bit of a bid, and I think that's going to really play into the U.S. story. We're going to check that in just a moment. But again, it comes down to commodities, as for Europe it has for the last year or two. Natural gas futures coming out of Netherlands higher by 2%. The strikes that you are seeing in Australia having a real effect on just how much supply Europe can get. And remember, this really matters as we talk about the forward contracts. It is getting cold in Europe. It is getting chilly, and that means that you start having to price in what that winter supply looks like. So that's going to be a story we dive into in the rest of the show. Let's get to the U.S. here, because that green on the screen is actually translating to the U.S. session. You are seeing futures higher by about 0.2% for a radio audience, 44.87 on those contracts. But again, the outperformer in the U.S., and again, be fair, it's only been about an hour of individual stocks trading higher. The NASDAQ 100 futures higher by about 0.3%. So again, right out of the gates on this summer Monday, a little bit of a bid into the tech space, and I would argue a slight bid into the bond market as well. Although if you look at the 2-year, the 5-year, the 10-year, the 30-year, not a ton of action just yet. Does that change as we get more information throughout the day? And of course, Brent crude, our obligatory check, an 86 handle on that commodity, down about 0.6%. Again, this makes sense as we talk about that pullback you are seeing in all of Asia, which brings us full circle to our top story today. China's banking regulator has set up a task force to examine risks at one of the nation's top private wealth managers. This comes after a unit missed payments on multiple high-yield investment products. The looming crisis in the Chinese property sector, it's weighing down the country's economic recovery. Joining us now is Bloomberg's Sofia Horta Acosta. Sofia, you are an expert on all things China. You are now based in London. Let's really tap into that.
Company. It was rated investment grade as recently as June last year. This really shows how it's a liquidity issue, a cash flow issue, rather than a bad debt management issue. So Country Garden does have cash on hand. It will probably use that cash to finish, to make sure that it delivers home projects that are being built. That was one of the key issues last year when we had those protests across China on unfinished homes. So we will see kind of a different story being played out here. The difference, or what's worrying markets really, is that, if this can happen to Country Garden, how deep is the crisis here? This is a company that was seen as a survivor in the market. It's also much more exposed to China's kind of low-tier, smaller cities than Evergrande was, which is not the focus of China, of stimulus and of support from Beijing right now. Beijing is, of course, trying to kind of manage the downturn in the property markets. It is engineering this. This is something that Beijing wants to happen. It does want the property crisis, the property markets to drop, but drop in an orderly fashion. And I think, Kriti, that is proving a lot harder to do than Beijing had anticipated.
I'm so glad that you brought this up as kind of a case study on the broader property market, because this is one of my big questions sitting right here in New York and not necessarily monitoring the tick-by-tick moves. As we talk about kind of whether Country Garden or Evergrande is a kind of harbinger of what's to come when it comes to the broader property market, it feels like the, I don't want to say excuses, but the kind of defenses of each company is simply that, well, this is a isolated issue. This is a very specific to the way this or that company operated. How long do you think, in your professional opinion, will it take for this kind of full domino effect to play out in the Chinese market? And when can the Chinese government perhaps get ahead of it?
I think that's a really good question, and that is really at the center of why the market fell so much in Hong Kong and onshore China today, is because of this fear of contagion, because it's not just the property developers. These are the Evergrande, the Country Gardens, these are the companies that build homes. We know that there's a demand problem there. There's also a cash flow issue because these are incredibly capital intensive companies. But what we saw today, kind of in the middle of all this, all at the same time, was this wealth manager that failed to pay what it owed on trust products. Now, I'm not going to go into very kind of deep minutiae here, but wealth products or trust products are essentially what wealthy Chinese invest in. So it's, these companies pool all this household capital. It's about $3 trillion, so it's not a small industry. And then they invest in usually high-risk investments because they need to kind of deliver high yields. And this company was exposed to the property market. Now, this is where the contagion happens. It invested in the property market. About 11% of its assets are exposed to that industry. Last year, because it was expecting, it was betting on a recovery. Now, that recovery is not coming through. I think that's what's surprising, not just people in China, but people outside China is, we did see this kind of change in policy out of Beijing more than a year ago now, and it's not helping. So what could Beijing really do if it does want to turn around this market? If things start looking a bit uglier than they are now, and they start kind of infecting the rest of the economy, what levers can China pull? And I think that's what's really making people nervous now.
I'm so glad you mentioned that. Again, in our last minute, Sophia, one of my favorite kind of fun facts, I always throw it at Danny when her and I are anchoring together, it's simply that if you compare this to some of the other kind of Chinese crises in the past, I love to look at 2009 simply because of the massive infrastructure investment they made, which had a real read-through into the rest of the global economy. There are some folks out there who say the recovery that we saw in 2009 in the US, in Europe, post-global financial crisis came from that massive infrastructure investment. And I'm just wondering, as you look at kind of the contagion effect, of course, within the country of China as well, how does it kind of filter through to the US, to Europe? Is there a real read-through, just given the sector is so different from anywhere else in the world?
Yes, and I do think a lot of people were expecting that to happen, and this is the kind of the danger with looking at history. History does rhyme, but it doesn't repeat itself. And when it comes to China, those lessons from 2009, what China did to engineer that recovery was really kind of pump debt into the financial system, and it's dealing with that debt hangover now. I mean, it's trying to diffuse risks in the financial system. What happened with infrastructure spending, building bridges, building airports, there's only so many airports you can build, Kriti. That is no longer something that China can do. It no longer makes sense, and you have this kind of excess capacity as well. So there's no easy fix when it comes to growth. Not just that, but Beijing also wants to pivot that growth. It no longer wants to, first of all, rely on infrastructure as the key driver, or the property market. It doesn't also want to rely on exports because you have demand in Europe and the US weakening. You also have, friendshoring and all those themes that we've been talking about for months and months. So it's really trying to revive the domestic economy, and that relies a lot more on the consumer and on households, and that's, sentiment is still incredibly weak there.
I mean, you could argue that the shift in the focus that you just outlined, Sophia, essentially makes kind of this argument that maybe China, and I'm going to get a lot of flack for this, I know already on Twitter, maybe China is actually pivoting away from being that traditional EM kind of country that we were talking about, and these are the kind of the shifts into services, into the focus on consumer, away from infrastructure that helps it kind of compete with other developed economies. A topic for another time, if we will. Bloomberg Sofia Horta Acosta covering all things China for us this morning. Let's go from China to the U.S. because again, one of the read-throughs is the big question. Is this something the Federal Reserve has to worry about? Well, economists at Goldman Sachs are looking at the Federal Reserve, and they're actually predicting that when it comes to monetary policy, they're going to start lowering interest rates by the end of next June. The Wall Street Bank anticipates 25 basis point cuts per quarter, but expects no more hikes to come this year. They say the cuts in their forecast are driven by the desire to normalize the funds rate from a restrictive level once inflation is closer to the target. Joining us now is Bloomberg's Valerie Teitel. Valerie, walk us through this call here, because I think it's pretty surprising that Goldman is actually pricing in cuts in 2024 when I feel like the market is now saying, well, maybe it's further out.
Look, I think the interesting thing, Kriti, here is they're calling for cuts, but it's not because they see the economy slowing down. It's not because of a hard landing. And it's just clearly because they think the Fed is going to aim towards policy normalization next year. They see 25 basis point cuts per quarter from the end of June based on that desire to normalize the Fed funds rate from a restricted level to maybe a more normal policy level once that inflation is closer to target. To me, this was clearly prompted by
by last week's inflation print, which showed that month-on-month coming in at 0.2%, which if you annualize is below the Fed's 2% target. They do see, very interestingly, the Fed funds rate cut eventually to stabilize around 3 and 3.25%. So that's Goldman there throwing their hat in the ring on where they think our star is, where they think this neutral rate is for the U.S. economy, 3 to 3.25%. I would say it's above the Fed's expectations of 2.5%, but below where the market is currently pricing the long-term Fed funds rate at 3.6%.
What changes that, though, Valerie? I mean, when we have these kind of market strategists, the easy question to ask is, hey, you're bullish. What undercuts that opinion? Valerie, what undercuts Goldman's call here?
Well, they think that there's a risk that these cuts could come more quickly, and that is just underlying if the Fed becomes a bit more confident that inflation is falling back towards the target. But they do note, Kriti, that these cuts could also come not at all. They note that normalization, a policy normalization move, isn't necessarily an urgent need to cut rates. So there could be a risk that they have to keep rates higher for longer, and those cuts don't come next year.
Well, Valerie, all right, I'm going to tap into your kind of bond market expertise here. Roll with me. If we talk about cuts, essentially that kind of baked into that logic is simply this idea that the economy's kind of drastic slowdown, which again happens in every economic cycle, will come far quicker than expected. It's not going to be that gradual slowdown. It's not going to be that soft landing. It's going to be some sort of more dramatic drop. But is there really any evidence almost a year out from where Goldman is talking about these cuts to see that play out?
Well, look, you have to think that one of the reasons why the Fed could want to cut rates is just because there is no need to hold rates at this restrictive level if inflation is falling back to target. You can almost take growth completely out of the picture there, Kriti. If we're having inflation falling, if it is running at 0.2% month on month, what is the need to hold rates so restrictive? And I think that's what prompted this call from Goldman, and is maybe having the market's eye taken a bit away from the growth picture, but just on this real yield story, right? The U.S.'s Fed funds rate is at a real positive territory for the first time in a long time. And is there a real need for that if we see inflation dropping this quickly?
Is there a risk, though, that we talk about the Fed potentially holding this rate at this restrictive level, as you point out, but we're seeing this resiliency that exists in the U.S. consumer and U.S. business spending as well? Is there a normalization of that higher rate? I mean, this is the entire kind of concept we had earlier on, which is a 2% inflation target even the norm anymore, or even the long-term norm? And Valerie, I know this requires a lot of kind of fiscal changes, a lot of legislation in Congress, but in terms of the actual economics of it, is it possible to have a longer-term restrictive rate just stay there?
Well, I think one of the risks to that, Kriti, is that this government spending, this Bidenomics, all of this government spending that we have seen does keep the economy stronger for longer, and maybe does push up where that R star, where that neutral level for the U.S. economy is. And I think that's one of the risks out there, perhaps, to this Goldman call, is that, you know, we're headed into an election year, Kriti. Governments like to spend during an election year. Democrats surely don't want to see a recession as U.S. voters go to the polls. So does that maybe boost to fiscal spending just push farther and farther out where the Fed cuts rates, because maybe inflation becomes a bit more of a problem? Maybe we see a resurgence in inflation because of that growth impulse from the fiscal spending from the government.
I love that you mentioned the fiscal spending. Valerie, you read my mind. This is why we have you on every morning. Bloomberg's Valerie Teitel walking us through the monetary and the fiscal story this morning. We thank you as always. Let's go from the macro to a little bit of the micro. The biggest deal news this morning, U.S. Steel rejecting a $7.25 billion takeover bid from rival Cleveland-Cliffs. It's going to begin a review of its strategic options instead. U.S. Steel announced a formal process to assess its alternatives after receiving approaches for parts or all of the business on Sunday, with Cliffs going public with its offer just hours later. Now, Cliffs did say it submitted the proposal privately on July 28th and received a rejection letter calling the offer, quote, unreasonable, despite representing a 43% premium to the steel maker's last close. Now, U.S. Steel confirmed the response, but defended its decision, saying that Cliffs had refused to sign a non-disclosure agreement unless the Pittsburgh-based producer agreed to the economic terms of the proposal in advance. Now, of course, this is a really important deal because the combination of the two would help the likes of Cleveland-Cliffs really compete with the dominant players in the rest of the world, specifically that are located in China. We're going to ask the CEO about that at about 11:30 a.m. Eastern. The CEO of Cleveland-Cliffs, of course, joining Bloomberg Markets with Alex Steele and Guy Johnson. It's an interview you do not want to miss on the deal of the morning. Now, coming up, an unexpected win in Argentina as an outsider congressman upended this year's presidential race. More on that next. And later this hour, we're going to catch up with Svea Slim, Bank of America's head of European interest rate strategy. We're going to ask her about that Goldman call. Is it worth it? Is Bank of America on the same page? What's the read-through? All of that coming up next. Plus, we're going to hear from the author of Chip War, the fight for the world's most critical technology. A really interesting story as we talk about China, Europe, and of course, the highly expected ARM IPO. All of that still ahead. Stick with us. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Let's get to some news in the emerging markets. In Argentina, primary election results are in, with outsider Congressman Javier Milei polling in a surprise win. Bloomberg's Manuela Tobias has more.
Argentina witnessed an absolute upset on Sunday night's primary presidential election. Javier Milei, an outsider third-party libertarian candidate, took 30% of the votes, winning as the highest voted candidate in the race. He outpaced the opposition coalition, who had, two candidates competing for the nomination, and the incumbent party as well. He outscored everything that the polls were expecting, which were pegging him at around 20%, no more. And it is just an absolute surprise compared with, as well, what markets were expecting. Milei has been compared with Donald Trump and Jair Bolsonaro. He represents his own libertarian party. Within all of the different market scenarios, a Milei upset was the least desired by markets. So this is likely to be received with fear. Investors like his economic message of slashing public spending, but he has an aggressive style and lacks any sort of party structure that would allow him to get the changes that he needs to make in Congress, over the finish line. He also, we're expecting a sell-off, definitely in the parallel exchange rate that analysts say could be around 15-17%. We're also expecting bonds to drop lower on continued uncertainty and the expectation that this election could go to a second round. We have a general election in October, and that could go off to November now that this race has been divided in 3 parts. Manuela Toyas, Bloomberg News in Buenos Aires.
A live report there from Buenos Aires about a crucial election in the emerging markets. Of course, we will bring you all the updates as we get them. Now, coming up on the show, wheat rises as Russia fires on a cargo ship in the Black Sea. More on that next, and the commodity read-through coming up. This is Bloomberg.
Markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Let's turn to some of the stories that caught our eye around the world. Wheat edging higher after Russian Navy forces have fired on a cargo vessel in the Black Sea. The carrier had been heading to the Ukrainian port of Izmail, but was fired upon when no response was heard for a request for inspection. Of course, you are seeing wheat futures rise on that news, higher by 1.2%. More ahead, this is Bloomberg.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China sets up a task force to examine risks and potential debt after one of the nation's top private wealth managers missed payments on multiple investment products. That, of course, alarming investors with fresh anxiety about the health of the shadow banking industry. And Goldman Sachs pencils in the first Fed rate cut. Economists there expecting the central bank will start lowering interest rates by the end of next June, with a gradual quarterly pace of reductions from there on out. And in deal news, U.S. Steel rejects an over $7 billion takeover offer from rival Cleveland-Cliffs that promised to create one of the world's biggest steelmakers, after calling the bid, quote, unreasonable. I'm Kriti Gupta in New York. Danny Berger is off today. Let's get a quick check on these markets here, because in the Asian session, you did see a lot of pain. You did see red, a massive sell-off, a lot of that coming from weakness out of China, concerns around the property sector. But then, hey, if you look at what the European market is doing, not that same sentiment crossing over. You actually saw a little bit of green on the screen there, and that is important as we talk about the European stock 600 actually getting a little bit higher. And on top of that, that actually flowing into the U.S. story as well. Futures higher by about 0.2%, 44.90 on that contract. And again, you are starting to see, we're going to go back to Europe here, outperformance in that German index. And I would argue that in the US is a little bit different because you're seeing outperformance in the tech side here. Now, let's talk about the bond market because that's really where you're seeing a lack of action. It's interesting. The equity market is moving, given on that light trading volume, but the bond market doing something a little bit different. 2.61 is your number on that German 10-year, a slight bid in the terms of direction, but again, it is kind of staying fairly unchanged. If you look at the U.S. session, you are seeing it a similar story. Let's go to the commodity story, though, because nat gas is higher by about 1%. A lot of that coming off of concerns from those Australian strikes and what that means for LNG supply, natural gas supply broadly for the European continent as they're going into those winter months. And of course, Brent crude is also going to be an important topic here. You are seeing it trade at about an 86 handle, down about 0.2%. So the commodity story gets really, really interesting as we talk about these global dynamics. Remember, we're also dealing with a war in the Black Sea, where you're starting to see grains and oil start to get really affected by that dynamic between the Russia and Ukraine, and essentially the grain deal split apart as well. Not to mention the Iran prisoner swap as well. What does that mean for Iran oil cargoes entering the market? Now, all of this is going to have an effect on inflation, specifically in Europe, and that is going to matter as we talk about the global inflationary dynamics. Let's dive right into it with a true expert. Sfia Salim, head of European interest rate strategy, joins us over from Bank of America. Pleasure to have you on this morning, Sfia. Let's start there. You're seeing a lot of movement in the commodity sector. You're seeing a lot of concern about what the winter months in Europe might actually look like, not to mention what 2024 might look like. Is this the end of inflation? Let me put that to you. With the commodity risks that we are seeing, do we start to see another bump in European inflation?
Well, actually, investors don't seem to be thinking that way. So we surveyed a whole set of fund managers, fixed income fund managers last week, and found that actually in our FX and rate sentiment survey, we have a net percentage of investors who are expecting higher commodity prices in the next 6 months, net 17%. And yet their inflation expectations have moderated. For end of 2024, we now have 80% of investors who think that Eurozone inflation will be sub 3%. That number was just 55% last month. So it seems that this commodity these commodity pressures are not having yet an impact on expectations in the long run for Eurozone inflation.
Does that create a dislocation, though, when you look at the European kind of interest rate market? We'll get to the U.S. in a moment, but in terms of kind of pricing that in, how do you position for something like that if that is your base case for hypothetically 2024?
So at the moment, investors are long. In fact, they're even longer than before the sell-off. They have bought the dip in fixed income. And today in Europe, they are actually at their longest or most overweight position in more than 2 decades. So they are positioned for the end of cycle trade. I would say that it's impacted by these inflation views, but also the view that supply in Europe may not have much of an impact on interest rates. We tend to disagree for the near term. We are actually arguing that we may see a little bit more upside pressure on European yields for the next few months because supply is going to be quite elevated in Germany and France. And if you put that in a context where data may outperform very weak expectations, we think there will be a bit more upside in yields before the rally can kick in Q4 this year.
I'm so glad you brought up the supply story here because, of course, stateside, that is going to be a major concern about just how much this bond market can really handle that extra issuance coming out of the Treasury. But Sfia, talk to us about that from an ECB's perspective here that's actively trying to tackle QT as well. I mean, can the European market actually handle that excess supply? How much of the plumbing story worries you?
Yes, that is a good point because we are seeing actually a big change in behavior from the ECB here. The ECB seems to be in a very much of a cost minimization trajectory and focus. So we have seen that they have increased or lowered the remuneration on minimum reserve for the banking system. And we think that in this context, they are likely to also start early PEP QT. They have so far committed to ending or continuing full reinvestment in PEP purchases until the end of next year. We think they will change their mind and start a roll-off in the middle of next year. And that, of course, yes, will put more supply pressure in the market. But the context matters. Near term, if global data continues to outperform the weak expectation, that supply may be harder to digest. But when we see rate cuts really at the door in 2024, that supply may be a lot more easily absorbed, we think.
Svea, you're reading my mind. I want to go to rate cut next. Before we do that, though, I want to talk a little bit about the numbers. You're talking about potential losses coming from the ECB. Put a number on that for us.
Yes, so on their APP portfolio, the ECB has recorded or unrealized losses at the end of 2022 of 400 billion, we estimate. And they are on an ongoing basis facing negative carry. This is 60 billion approximately of negative carry per annum. So what we think they will be doing is trying to reduce a bit the cost by reducing the remuneration of some of the deposits. They've done that in minimum reserve requirements of the banking sector. Now we think they will also be lowering the remuneration of government deposits, of foreign central bank deposits, but also at the same time trying to reduce the balance sheet, which we think they will do through PEP roll-off rather than active QT. Because for active QT, you're actually going to be crystallizing those unrealized losses. And we think this is the least favored option here for the ECB in this context.
I mean, President Lagarde clearly has her work cut out for us, for her, Svea. Let's go back to the rate cut story that you were just talking about, though, because, again, we've been discussing this theme throughout the last couple of weeks. And, of course, in today's trade, of course, Goldman Sachs penciling a rate cut for the United States in the month of June of 2024. Svea, in terms of rate cuts when it comes to the European story, are they on a similar timeline, or is this really where in the next, say, year or so, you see Fed policy and ECB policy diverge more substantially? What do you think?
That's a very interesting question, because actually we were thinking the ECB will probably take a bit longer to cut rates. But now that we're also seeing the resilience of the US data, our economists have also pushed back the timing of the first Fed cut. So now we have them along the same trajectory. One more hike to come in September, and then the first cut for both central banks coming in June next year. And the cuts are natural in this environment because central banks are very much in a restrictive territory here. So just a slowdown in inflation towards target should be enough to then get them to cut rates in the middle of next year.
Certainly a lot to digest and an interesting conversation to have on, again, a summer Monday, if you will. Svea Salim of Bank of America, we thank you as always for joining the program. Coming up, we go from the rate story, from the inflation stories, to I think something that really feeds in. We're going to talk about chips and how that factors into the geopolitics. We're going to hear from Chris Miller, the author of Chip War, the fight for the world's most critical technology. All of that still ahead. Stick with us. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. we'll just have a rebalancing onto the continent. And actually the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Now, I'm very fascinated by the chips conversation, the geopolitics that we're talking about. We talk about NVIDIA, Intel, the ARM IPO, but how does this all factor in, or is this a 10-year-long story? Now, folks, I've had this book on my nightstand for about 6 months now, and I have been obsessed with getting the author of it on this show. And that's what I'm bringing you this morning. Chris Miller, Director of Eurasia over at Green Mantle, and of course the author of Chip War, The Fight for the World's Most Critical Technology, joins us this morning. Chris, I want to put that question to you. I am fascinated by the chip story. I'm fascinated by the geopolitics of it all. We are talking, or hearing, I should say, from President Biden and his administration to really domesticate a lot of this chips production. How far away is that independence that we're talking about, that deglobalization? How long until the U.S. can fully make chips on their own?
Well, the U.S. is never going to be completely self-sufficient in semiconductors. The supply chain is just too complex, too internationalized. But the $50 billion the Biden administration is spending will build a lot of new chip-making capacity, funding companies like Intel or Taiwan's TSMC to build new manufacturing facilities. And the goal that the U.S. has is to increase the share of chips that's produced in the U.S. Today, it's around 10% of the world's chips that are made in the U.S. The Biden administration wants that number to be 15, 20, 25%, which is substantially higher than today, and will take a lot of money to get there.
But that investment that you're seeing from the Biden administration specifically, in the context of simply just how much this industry is valued, it feels like a drop in the bucket. Is it really going to be making that much of a difference?
Well, you're right that the industry's capex each year is huge, and government subsidies, though large, are small in comparison. I think if you look at the government subsidies next to shifts that are changing the way the industry thinks about investment patterns, and the big shift here is a decoupling from China, which the industry isn't happy about, but it realizes that as tech gets more politicized, it's got to change its investment patterns. And so the incentives the government is putting into the industry are really only part of the story. The other part is regulation. Government saying, here's what you can and can't do vis-a-vis China. That's changing how CEOs are thinking.
All right, Chris, let's talk then a little bit about the process of what it takes to actually increase that self-sufficiency. If not to 100%, then perhaps increase just how much we're able to create stateside. Talk to us about the labor involved here. I think I read a stat simply that although you are seeing cheaper labor, of course, on the entry level over in Asia, when you get to those mid-level or higher level roles, in the engineering story, you're actually neck and neck with American wages. Talk to us a little bit about the labor story there.
Yeah, that's right. Inside of a chip-making facility, the jobs involved are very high-skilled, very unique types of know-how. And so the reason that there's been so much offshoring in recent decades is not primarily about labor costs. The challenge the U.S. faces isn't the cost of labor. It's having engineers trained in the exact right disciplines that are needed for chip-making. And right now, there's a huge number of programs being set up between universities and chip-making companies to train a new generation of engineers that are skilled in semiconductors. And it's going to be a long time to undertake this training because there's really unique know-how that's required, and the U.S. has not been training the number of semiconductor engineers that it needs.
You know, it's interesting you mentioned that. Bloomberg Intelligence had moderated a panel with some of the C-suite over at Intel, and they said, look, part of their investment story from the money they're getting from the Biden administration is investing in that engineering story in the likes of universities that are close to the plants that they're building in Arizona, of course, the Northeast Corridor as well. But Chris, talk to us then about how companies broadly are positioning right now. I mean, you read these headlines about NVIDIA, for example, or Intel becoming the kind of anchors for the ARM IPO. Is that going to be enough in terms of kind of securing that vertical integration?
Well, I think that's part of the story, but companies are thinking a lot beyond that. ARM provides the architectures, the designs for semiconductors, but they're also thinking harder about the chemicals, the silicon wafers, and the assembly and packaging that happen at the end of the supply chain. Right now, you see companies that used to ignore their supply chain, think more, invest more, partner more to gain the resilience and security they need from the earliest stages of the supply chain all the way down to the packaging and shipping to customers. And that's where you actually have the biggest change right now in the bottom of the supply chain, where chips are assembled and packaged before they're sent off to customers. Today, almost all of that work happens in East Asia, and a lot of it happens in China. And that's where you have companies reducing their investment in China, trying to build up new assembly and new packaging facilities in places like India, Latin America, Vietnam, and elsewhere outside of China.
A lot of which I imagine is driven by those subsidies provided by the government, which brings me to the European story, Chris. We're talking about the ARM IPO, ARM, of course, based in the UK at the moment. But you've heard the likes of Emmanuel Macron, for example, and even Olaf Scholz talk about bringing a lot of this semiconductor capacity to Europe specifically. But if you look at kind of the amount of companies that are actually there right now, the only two major chip companies I can think of are ASML, of course, in the Netherlands, and the ARM graphic designing capabilities. Is Europe the future for semiconductors?
Well, I think Europe has a strong future in the niches where its firms are leaders. If you look, for example, at the production of semiconductors for automobiles, there's a number of European firms that have very strong market positions. And that's exactly where Germany is investing, trying to make sure that those firms have guaranteed manufacturing capacity, most notably via a recently announced joint venture with TSMC, the Taiwanese chip maker that's the world's largest. And so I don't think Europe's going to be a dominant player in the chip industry, but European governments are investing a lot to make sure that their firms that are players in certain niches retain their position.
All right, Chris, in our last few minutes here, let's talk a little bit about pricing power, if we can. It feels like when you look at the history of chips, and you really kind of go into depth about this in your book, this idea of shifting from Moore's law, essentially the ability to kind of cut the size of the actual chip itself, to something like the Internet of Things. Does that create a more expensive chip for the end consumer?
Well, prices have been falling year after year, but it's getting harder and harder for chip companies to find new ways to cut costs while adding new performance. One of the key changes you see right now in the industry is a focus on what's called advanced packaging, new ways to put chips together to add new capabilities onto semiconductors. And this is a huge opportunity for many firms across the industry, but it's also a competitive challenge because it threatens to upend the way that chip companies differentiate their progress. And industry leaders from TSMC to Intel are trying to develop new packaging techniques, market them as a key differentiator. But they face a lot of competition from newer firms and smaller firms that are trying to win market share based on their new packaging capabilities.
It's interesting that you mentioned that. I'm going to end here with the final question when it comes to EV, AI, et cetera. We're talking a lot about this run-up in terms of AI and the data centers meant to power it, and even argue even the metaverse, for example, is a big part of that story. Chris, is the capacity pre-existing in the chip space right now to catch up to this massive investment we're seeing in AI?
Where you see real deficits right now, in particular in the chips that are used to train AI systems, chips that are made by NVIDIA or designed by NVIDIA but manufactured by Taiwan's TSMC. Companies can't get enough of them, and TSMC can't make them fast enough. So I think the next couple of quarters, we're going to see continued investment in chip making capacity precisely for chips used in AI applications.
So much to digest. Chris Miller, I could talk to you for hours. Thank you, as always, for joining the program. Chris Miller, they're the director over at Green Mantle. He's also a professor over at Tufts University, and most importantly, the author of Chip War, The Fight for the World's Most Critical Technology, a book you're definitely going to want to dive into. Coming up on the show, look at some of the market-moving events to watch throughout the week. Stick with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York. Let's take a quick look at what's going on ahead today. Overnight, we're going to get a slew of data coming out of China, more perhaps insight on what that property slump actually looks like. Then, of course, we get UK jobless claims and U.S. retail sales all on Tuesday, not to mention the retail earnings that come with it this week, kicking off with Home Depot and, of course, Target, Walmart reporting later in the week as well. We also have Eurozone GDP, UK CMI, and FOMC minutes all on Wednesday. And finally, we round out the week with Eurozone CPI and UK retail sales on Friday. So if you were worried about needing more data points in terms of the slump in China or even the slump in the UK, this week is your week. That's the macro story. Let's get to the micro here and look at some of the stocks we're watching in pre-market trading in the United States. It is the deal of the morning, or potential deal, I should say. U.S. Steel starts a review. It spurned a $7.25 billion bid from Cleveland-Cliffs. Now, these are two of some of the largest steel makers in the U.S. Cleveland-Cliffs, of course, making their name on iron ore specifically, but if, hypothetically, they were to be combined and U.S. Steel were to accept that offer, it could create one of the largest steel makers in the world, going neck and neck with some of the dominant players in China as well. U.S. Steel higher by about 24% this morning. Cleveland-Cliffs taking a step back, 6.7%. Another couple stocks we're watching here, AMC and APE. Now, it's the same kind of company. AMC Entertainment shares down about 28%. AMC Entertainment Holdings, those APE shares, higher by 28%. The court approving that stock conversion plan. So seeing a reversal of some of the stock flows that you are seeing earlier. And of course, we got to get a quick check on Tesla here. They are cutting their Chinese prices again. A slump in auto stocks around the world. Now remember, they had signed that truce back in July that really ended very quickly, ended before it even began. And simply they were going to say no more price wars in China. Tesla not abiding by that, down by about 1.8%. And of course, keep an eye on those big tech names because you are already seeing a little bit of a retracement in the S&P 500 from its peak at the end of July. That does it for early edition, folks. Surveillance is ahead. Stick with us. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
The inflation dynamics have maybe shifted slightly in the U.S.
We don't see really any possibility for the Fed to be cutting rates until next year.
I think there's a risk they cut faster than the market thinks.
It's clear that the future is going to be different than the past, i.e., for sure, higher rates for longer.
We need to stick to our work that tells us that a recession is likely to unfold.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market on the S&P 500 positive by 0.2%. Getting your week started, looking ahead to a big week for retail in America. Tomorrow morning, retail sales. On Wednesday, earnings from Target. Thursday, from Walmart. But how many times have we done this through August? Starting this morning, stateside, Tom, talking about China. China, the headline once again.
China, it's there. And Ann Maletti just talking in the opening there, getting all zen on us as well. Guess what? It starts and ends in China with a set of news. What's interesting to me about China is it's not one story. You got to get briefed on this to get up to speed on 3, 4, 5 stories about China. The summary is simple. Chinese equities in the tank. Iron ore somewhat in the tank. There's a lot of moving parts going on in China, and that redounds right back to Jay Powell at Jackson Hole.
Woke up this morning going from headline to headline, and that's the way we start this morning once again. One Chinese developer, a name you're familiar with, Country Garden Holdings, seeking to extend a mature bond for the first time ever. Away from that, we've got a wealth manager missing payments, Lisa. This all starting to mount in a bigger way.
Which raises a question of when this becomes financial contagion that really affects China, and then that affects the broader market, whether it's in the U.S. or whether it's in Europe. Why are we not seeing more sort of trickle-out effects of that?
We are.
Well, is that what we're seeing in Germany? Is that what we're seeing in parts of Europe? But a lot of U.S. companies, yes, they are ratcheting back their expectations for growth in China. Beyond that, where do you see the contagion?
I see it in the terminal. I see yen going out to new yen weakness, right up buttressed on 145 renminbi. Obviously, the Chinese yuan is right back to recent weakness as well. And I see it in a 30-year bank rate mortgage. I mean, here's the number, folks, this morning. There's many different mortgage rates, 7.53%. I think you can round that up to 8%, but I'm not there yet.
Do you see stress in the bond market, in treasuries? Last 3 weeks, yields are higher for 30 basis points. 30 basis points higher in 3 weeks. Lisa, I'm with you. 8 years ago, you get headlines like this out of China. This bond market's bid. Treasuries are rallying. Yields are aggressively lower. The last 3 weeks, yields are higher. Life above 4%. Can we sustain life above 4% on a 10-year?
It's a great question, especially in light of weakness that people feel coming from China and then the sort of surprising resilience of the U.S. consumer. It's such an interesting dichotomy that we get a slew of Chinese data, which we'll go through in a second, pointing to all of this weakness that we keep hearing about and seeing evidence of. And then we see also the consumer and what the U.S. consumer keeps doing, which is spend, 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 even if it's above their means.
There's some real tension out there, TK. Look at what's happening with crude. We're talking about a China slowdown every single morning. Deflation, disinflation, bad economic data. Crude's up more than 20% off the June lows.
Bring it, as you mentioned retail earnings today. We'll bring it back to my 201k. What do you do if you're in stocks and you're listening to all this talk about macro babble? I'm not quite sure what I do.
Well, what a lot of people are doing is they are diversifying, right? They're going into commodities, which raises a question. How long can you continue to go into some of these areas if China ends up being the major macro story that people are not paying enough attention to?
Really fascinating time. You don't get a quiet summer. We're getting deeper into summer. Jackson Hole about 10 days away. It's an interesting time, TK.
It's very zen.
The future's going to be different to the past.
It's true. We got a 12-hour. Should I go hiking?
You said that was zen.
Yeah.
It's very zen.
Should I go hiking in Jackson Hole?
You going hiking next week?
Well, we got like a 12-hour window, and
Lisa goes hiking.
Get my stick. If you're over.
Lisa went canoeing last year in Jackson Hole.
I've got big plans this year.
Have you?
But there's snakes.
Canoeing again.
If you go seriously, if you go hiking in Wyoming, there's snakes, right?
And bears.
Bears, elk.
All of the above.
Snakes.
Snakes? Is that what I'm worried about?
You're more concerned about the snakes?
Oh, yeah. Like where we sleep. We don't stay, folks, we're staying like a Motel 6.
Whoa. We are not staying in a Motel 6, number one. And number two, what, you think that a snake is going to get into your room?
When I walk into my room, I'm looking under the bed to see if there's snakes there sleeping.
I'm staying in a different hotel to you.
Are you?
Yeah.
You're probably in the Ritz.
Let's get to the price action. The Amangani. Very nice. Equity futures on the S&P 500 up by 0.2%. Equities advancing today. First back-to-back weekly loss on the Nasdaq 100 of the year so far. How about that for a stat? The first back-to-back weekly losses for the Nasdaq 100 for the year so far, closing out last week. For a week of losses as well on the S&P 500. Yields above 4% on a closing basis. Thank you, Stuart Kaiser, for this stat out of Citi. Above 4% on a closing basis for a 9th consecutive session. And Lisa, going back over time, it's actually quite rare to see that.
Especially at a time when a lot of people are arguing that we're going to go back to a low inflation kind of moment. And you've got Goldman Sachs calling for rate cuts, which we'll get into in the second quarter. As far as today, it is light ahead of a week of really dominated by retail sales. But I am focused on China. Today, James Bullard is leaving his role as St. Louis Fed president to become dean of Purdue University's business school. He was actually one of the most novel voices. He was a hawk. Are there hawks left? What does a hawk on the Fed right now mean at a time where they're looking for a soft landing? At 5 p.m., Treasury Secretary Janet Yellen is speaking in Las Vegas. This is the tour that we see from all Biden officials talking about the Inflation Reduction Act and what this can do for the U.S. economy. Curious to see what she says about China, though, especially in light of this. 10 p.m., China is releasing July economic data, including industrial production, retail sales, and jobless information. This comes at a time when broader markets have largely shrugged off China. Can they continue to, John? At what point does the data supersede the calm of a soft landing in the U.S.?
So we've got to do three things this morning. Talk about China, talk about retail sales later this week from companies and the official data itself, and talk about developments in this bond market. Lisa, thank you. Let's kick it off with Ben Laidler, Global Market Strategist over at eToro. Ben, let's talk about this bond market. Life above 4% on a 10-year. Can it be sustained? And ultimately, what does it mean for your equity market?
I don't think it can be sustained. You look at 2% real yields. You've got to go back 15 years to see them being reasonably sustainable to before the global financial crisis. You look at this 4% US GDP nowcast we've got. You've got to go back, 20 years outside of the pandemic. So I think this is pretty much the top. And I'd absolutely be leaning against this. I think the deflationary forces are still out there. We've had a bit of a sort of reset. Given growth has actually been firmer than expected. We've had this sort of headline last week of this turn up in inflation, but I'd absolutely be leaning against this. I'd be looking to sort of bottom fish a little bit, if that's the right terminology, after the massive rally we've seen in tech. I still think sort of long duration assets are the place to be.
Ben, the Wall Street Journal, I believe on Friday, had a wonderful article looking at 5 retirees, each of them with $5 million each, $4 million, $5 million. And the constant theme of these 5 different families was they bought tech, they own tech, they stayed with tech. The heart of your note is you say tech is not going to tank, that tech has more in the tank. How do you look at tech and say they got legs to continue?
Look at the earnings season we've just seen. Where did the growth surprises come from? Where did the absolute growth come from? It came from all these sort of tech-heavy sectors, consumer discretionary, communications, and IT itself. I mean, these are secular growth sectors, which are seeing some top-line growth, but are also had a lot of fat to cut. And I think you're beginning to see that come together. So to the extent that U.S. equities get led out of this earnings recession and this earnings trough we've just seen, I think we've got the sort of glimmers of hope that it's tech that's going to lead. And on the valuation side, I think bond yields back off. And that'll take, I think, the ceiling off valuations that you've had put on over the last month or so.
John was just talking about how you've seen a 10-year yield above 4% for 9 consecutive sessions. At what point do you start to rethink just how far the yield can fall, and that makes you reassess your whole call when it comes to the equity space?
Yeah, obviously, if it goes much higher, or the fundamentals actually change, and I don't think they have. I think a lot of this bond yield move is technical. A lot of issuance, the changes what we've seen out of Japan. I look at our sort of fundamental growth indicators, and they actually haven't changed that much. I look at the gold copper ratio; it's basically flat. So and as I say, these numbers, this 4% nowcast on GDP, these 2% real yields. Those are really top of the ranges. If you look back long term, I'd be very surprised if we sort of break through that. I'm happy to take a move sideways from here, but I think the medium term direction is down, and that gives me some confidence, along with the earnings in tech, to be sort of nibbling at this pullback.
You say that it seems really technical in nature, and yet it's been accompanied with 7 straight weeks of gains on the crude level. We've seen a real rally into commodities more broadly on this idea of some sort of consumer rebound and resilience that we keep seeing in the U.S. How do you sort of pair this with the idea of a China slowing? I mean, how do you basically look at the commodity space and say the yield move has completely been technical?
I hasn't completely been technical, but you're right to flag oil, right? I think there are sort of two clear and present dangers currently for U.S. markets. Oil's the second one. This 70 cents rise we've had off the gasoline price low in the U.S. Is a sort of double negative, right? It takes about $100 billion out of consumer spending, which is 4 Macy's, just to put it in perspective, and it'll start pushing up consumer, inflation expectations. But I do think it ultimately is self-correcting. I think the higher oil prices go, the more people are going to worry about growth, the more people are going to worry about interest rates, and I think that'll cool the demand side. China's a big deal in oil markets, but it's only 15, 16%, right? It's a much bigger deal in industrial metals, and that's where you've been seeing the weakness. So I think we're right to worry a little bit about oil, but I do think it's self-correcting, and I do think a lot of the rally you've seen has just been the tightness on the supply side. But I think demand weakness will follow if Brent stays above 85 for very long.
Ben, quickly here, your claim is late 2018. You had the courage to look out 18 months. How do you look out 18 months from here and own and at the margin acquire shares?
Yeah, look into 2024. What's going to be happening? I think we're going to get double-digit earnings growth relative to the -5 we're seeing right now. I think we're going to have the Fed cutting interest rates, and that will support valuations. Those are the only two ways to make money in markets. I think valuations are going to stay high, maybe not go higher, and we're going to have a 15% swing in earnings over the next 12 months. That's how you make money.
You make it sound so easy, Ben. Ben Laidler, Victoria. Ben, thank you. It's good to catch up to kick off the trading week. I read the same article. I thought you were going to say the one thing they had in common, Tom, was that they were all broke, even though they had saved up $5-6 million. Didn't you get the same thing in that article? 100%. I read the same thing. We all did.
I give the Journal really great marks of this. They've really made a commitment to talking to people of all different socioeconomic outlooks on retirement. Some of it is not pretty. There's a huge part of America struggling. These people aren't struggling. These 5 families with 5. One guy's his wife died 3 weeks after he retired. I mean, brutal. Imagine that brutal. But the one thing I saw there was at some point they all decided to just name the tech stock and never sell it. That was a constant theme that I saw.
So the Wall Street Journal did some great stuff over the weekend, Tom. That wasn't my favorite story. My favorite story was actually the scary math behind the Treasury market. Lisa, I was going through some of the numbers, and I can share some of the article with you right now. Just highlighting the CBO's forecast and actually highlighting that maybe it's too optimistic. It envisions the net interest rate paid on the debt is barely topping 3% in the coming years, even though short-term bills and notes yield more than 5% today. And Lisa, some of this is it's worrying when you start to look at it. Just how much the interest payments will actually equate to non-discretionary, or rather discretionary non-defense spending in the years to come. It's pretty amazing.
So Peter Scheer read this, and he put out a note, and he was talking about this article. And on one hand, he was saying, well, it seems a bit extreme to us, and yet the details aren't wrong. And you read through it, and it is concerning. And he said he has to really think about his longer-term bond yield call. At what point do people reassess how long they can shrug off fundamentals that they've been able to shrug off for so many years and say this time is different with increasingly disparate markets in terms of buyers and in terms of economies?
So it goes back to that question that I shared with Ben Laidler moments ago. Can we sustain life above 4%? And who does it hurt first, the sovereign or corporates? What's most at risk here? The balance sheets of corporations that have locked this in for a long time, and the high yield players will ultimately refinance in the years to come, or the sovereign, which may experience the squeeze as well?
Well, obviously, they're somewhat interrelated, but I would argue some people are saying it's the sovereign more than the corporate. That's what we're seeing more and more, saying, go into a Google bond, you're probably going to get your money back. The U.S., you could be subject to all sorts of political shenanigans. You'll get your money back, but you could get, locked up in some sort of government shutdown.
Did you know the future will be different to the past?
I've heard that, I'm not sure. I'm really thinking about it.
TK, thank you for that.
Lucky and Maletti over at
Sebastian Page at T. Rowe Price is coming up from New York City. Good morning.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think this is all kind of nonsensical theater. I've made that clear to the RNC as well, way back, even before I entered this race, that I thought the pledge was a bad idea. And Donald Trump is now playing that game, but that's what he does. I would not be the least bit surprised if sometime around Sunday or Monday of next week that he signs the pledge and he shows up on the stage on Wednesday.
The first debate is next Wednesday, a week Wednesday. That was Chris Christie, Republican presidential candidate, on ABC over the weekend. The question remains the same. Will the former president be on that stage in Milwaukee? From New York City this morning, good morning to you all. Getting your week started with the equity market shaping up as follows on the S&P 500. 2 weeks of losses on the S&P, trying to bounce up by 0.25%. Concerns in China once again, missed payments, all that kind of bad stuff. Yields unchanged on a 10-year, 4.1581. And just a quick sneak peek of what's happening in foreign exchange. TK, the euro, 109.51 against the dollar, and basically unchanged.
Yeah, I kind of call it basically unchanged, but again, there's a tension to the market, John. I just simply want to go back to things that are buttressed right up against support or resistance, depending on what the chart is. And one of those is a 10-year real yield. I'm not at 180, I'm not at 181, but we've come back to an inflationista kind of 1.78%. That's not to be ignored.
You want to talk about some tension, just briefly? Did you read that New York Magazine article on David Solomon going into the weekend? Speaking of brutal, let me share the headline with you if you missed this going into the weekend. Is David Solomon too big a jerk to run Goldman Sachs? Tom, when have you seen a headline like that around a financial institution? When was the last time you saw anything like that?
That is the correct point. This broke on Friday, folks. For those of you internationally, this is a huge deal within New York and, frankly, within American Wall Street. And it's a combination of a New York Times article, Business Insider Lynette Lopez writing about his alma mater, Hamilton College, and some students were upset in that. But then the bombshell in the reporter for the New York Magazine, not New York Times, is really respected. I think that's the heart of the matter. This is not some journalist running around trying to make headlines. She's the real deal, Jen Wishner.
You don't write an article like this unless a lot of people are unhappy with the leader of a company. That is the bottom line. And I think that what you have to wonder is at what point this sort of issue and questions around his leadership become a bigger
Lisa,
problem
let me
for the
ask you this,
institution.
because John and I are just TV, radio animals, and you're not. You're the real deal from print. As Srinath Rajan told me, he said there wasn't all that much new in the New York Magazine article, but it was the language that was placed into sort of a hip, funky magazine versus something serious like Bloomberg News or New York Times. The language was shocking. John, the language was shocking.
That was scathing. Let's do the sporting analogy. If this was a US sports team right now, we'd be talking about a manager that's lost the locker room, correct? That's what it feels like right now.
Yeah, we call that Tottenham, but we won't go
What's
there.
intriguing about this, and Mike Mayo of Wells Fargo is quoted in the story, and he basically says, I've called for managers to leave in the past, for CEOs to leave. He's not made that call this time around. This feels so personal within the bank. Away from the performance of the quarterly numbers, this feels very personal within the bank. And that was a lot of people's takeaway, including my own, from that story going into the weekend.
You wonder where this is going into the weekend, going into the week. How do you stagger into September with this kind of cloud around any given firm? I mean, the cloud around Morgan Stanley is who's going to replace Gorman. I get it.
Well, that's different.
It's a derby. It's different. This is on a whole nother scale. What we're going to do right now is migrate. It's state fair season. Bramo is our state fair expert. If she was in Iowa at 11 a.m. this morning, the milking demonstration, John and Emily Putney Family Cattle Barn, milking parlor, north side of the cattle barn was what you do. Like cattle, they showed up this weekend to do the politics of Iowa. That would be selected Republicans. We go all State Farm, I should say, or State Fair with Isaac Boltanski, Director of Policy Research at BTIG. It's a silly season. Are they kissing babies out there? What are they doing besides gazing at the cattle and kissing babies? What are the Republicans doing?
They're beginning what's going to be a long and ugly fight, Tom. You know, look, there's a lot of this that's quaint, right? It's great to see a person who's running for president flipping your hamburger, right? A lot of this is good old school retail politics. But underneath the surface, there is a lot of disdain and a lot of uncertainty over how the next few months are going to go. Look, we have a debate next week for Republicans. We don't even know if we're going to have the leader in the polls, the former President Trump, participating. And so, look, I think it's quaint, it's cute, it's sometimes nice, but when you peel back that onion on your hot dog, you'll notice that it's pretty ugly, and it's going to be a long few months.
Isaac, you have the fabric of the Midwest in you, and of course with Ohio Wesleyan and all that. Is the Republican Party forever changed by former President Trump?
You know, look, I will tell you this, Tom. I have a fun job. I get to talk to Democrats and Republicans. And what I find interesting is that both Democrats and Republicans, at least from the more establishment wings of each party, are largely unhappy with the candidate who's leading in the polls for them, right? And so Donald Trump is the presumptive nominee at this moment. He is leading in the polls by a wide margin. President Biden is the presumptive nominee. He is largely unchallenged, except for one challenge, which I think has not shown any running room in the polls. And so what I've noticed here is a frustration with the leading candidates that perhaps can lead to a change in sentiment over time. But Tom, it's just hard to bridge that divide between what some party members hope and the numbers on the ground. And Donald Trump is going to get 30+% of the Republican Party in a primary race, no matter what he does. And when you have this many winner-take-all primary states, which is what we're going to see this time around, he is the nominee until someone proves to me that it's going to be someone else.
Isaac, I was reading a story over the weekend in the New York Times about the indictment effect, which is basically every indictment that comes out for Donald Trump basically boosts his popularity because it keeps him in the view of potential voters. How long does the indictment effect last?
Look, then the next one that I think all of us are watching could come from Georgia, and there's conversations suggesting that the grand jury is going to hear from folks this week with an indictment as early as the end of this week, next week, is what you continue to hear. I got to tell you, we have heard this phrase time and time again, Teflon Don. And I think that has proven to be one of the truest ways of thinking about this former president. His supporters simply don't care, and at times it gives them more fuel. For the average voter at the margin, it's not going to really change their opinion of him. If he's charged with RICO violations in Georgia, perhaps that gives him even more fuel to fight back against the dark state, the forces that are trying to stop him and hurt you. And it gives him the talking point that he wants. So to me, I continue to view these indictments primarily as political fodder that I think can give him more fuel on the campaign trail.
Keep us up to speed here, Isaac. Let's go through them one by one. So New York is about falsifying business records. They're the allegations. Secret documents, that's Florida. Washington's January 6th. What's Georgia?
So Georgia can be about, it will be their state level RICO statute, and so that would allow the Fulton County DA to pursue charges relating to the former president supposedly pressuring state officials to falsify or overturn the election results at the state level. And that one's really interesting because it isn't a federal charge, it's a state charge. So even if a Republican is in the White House in January 2025, you could not sweep it under the rug. And so that one has some unique powers. Furthermore, and this one I think is interesting as well, Georgia has been a little bit more willing to open up their courtrooms to cameras than New York or even the Fed. So that's also of interest.
Interesting. Isaac, thank you, sir. Isaac Boltanski, of BTIG? I'm sure I'm not the only one, Tom, losing track of some of this over the last few months.
I think the nation, even the supporters of the former president, are just benumbed by the whole thing. I mean, this is, to be polite, not normal, and I yearn for the way the British do it. I just, can we do this in 6 weeks? It ain't going to happen.
First debate a week away. At least we keep asking the same question. Is the former president showing up?
We know that the current president is showing up to Milwaukee tomorrow, I believe, to talk about the Inflation Reduction Act, so trying to get ahead of the Republican debates. There is this question, though, how long can people be benumbed? And a larger question also, are people equally benumbed on both sides of the aisle to issues on both sides of the aisle? Does it sort of just become, okay, this is now the new status quo?
Where is Anne-Marie? When's AMH back?
I can't keep up.
She's very European, isn't she?
She's
so Euro.
She's doing a Maria Tadeo. It's a full Maria.
Is that what this is?
It's a full Tadeo.
Maria's taken the whole of August.
They're like 4 weeks, or let's do 6 weeks.
Alcelinos of RBC is coming out from New York City. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
2 weeks of losses on the S&P 500. Here's the price action for you this Monday morning. Good morning, getting your week started on Bloomberg TV and Bloomberg Radio. Equity futures right now positive by 0.2%. The Nasdaq trying to bounce here. First back-to-back weekly loss to the Nasdaq 100 of the year so far. This morning positive by a third of 1%. All eyes on the Treasury market on a 10-year. Life above 4%. Can it be sustained? A move of 30 basis points higher over the previous 3 weeks. Yields going nowhere this morning. 4.15 on a 10-year. On a 30-year this morning, down a single basis point at 4.25. Let's finish in the foreign exchange market. The euro shaping up as follows, unchanged as well, 109.48. That is the snoozer of a currency pair over the last month or so, Lisa. I think you can guess where that is every single day.
It's either 109 or 110. It seems like it was 110 for a couple weeks. Now it's been 109. And you wonder this push-pull of who's going to blink first with the ECB or the Fed in terms of stopping on rate hikes and continuing to start thinking about cutting.
The ECB decision about a month away. Under surveillance this morning, China's banking regulator setting up, guess what, Tom? A task force to examine Zhongxi, a top private wealth management firm in Beijing, after it missed payments on multiple high-yield investments. The regulator will assess the outstanding debt and risks at the firm, which manages more than $100 billion of assets. Tom, missed payments, take your pick. We're talking about redoing the debt over at property developers as well. There's a lot going on this morning in China.
Yeah, what I would go to, John, here is the all-in guesstimate size here, and it's 100x billion, whatever, when you add it all up. But far more important than that is the what's the so what for Western viewers and listeners. And the so what, obviously, is weak yuan, but also Pacific Rim instability, where you get yen out to 145 and euro yen hasn't broken through. But I'm sorry, at 158.72, if you get strong euro, weak yen out to 160, all of a sudden, these things in China matter.
So it's the currency potential transmission mechanism, but there also is this transmission mechanism of at what point does this become a financial contagion issue, hinging on the mortgage market, hinging on the property market, because a significant part of the holdings of this private wealth management was property in China. You start to wonder, when does this snowball, given how much leverage they have and how many of the problems are really percolating to the surface with authorities that either don't have the power or the will to counteract it?
There's certainly some economic problems. Look at Tesla, cutting prices. Again, over in China. I know there's a separate EV story going on there, but sales of Tesla in China, not great recently.
Well, you've seen one company, U.S.-based company after another, talk about bringing down their estimates for sales in China. We saw that from Caterpillar. We saw that from a lot of other industrial companies. Why would Tesla be any different? There isn't the same will to spend. You could see a lot of Chinese consumers saving. They're hoarding money. Why? And this raises questions to longer-term economic prowess.
Let's turn to the next story. U.S. Steel rejecting a $7.25 billion takeover bid from rival Cleveland-Cliffs, instead opting to begin a review of its strategic options. In a letter, U.S. Steel calling the offer, quote, unreasonable. We'll have a conversation with the man behind that unreasonable offer, the CEO of Cleveland-Cliffs, at about 11:40 Eastern Time. That conversation, Lisa, later on this morning.
Okay, so here's the question. What do they have to propose instead? And again, this goes to this question of, well, isn't scale really important? So what do they have to do? What does Cleveland-Cliffs have to do to get U.S. Steel?
Wasn't clear to me about what happens with antitrust issues with this combination. What does happen? Is this something they allow?
Well, evidently, if it's not tech, they don't mind. But I mean, but really, I mean, to be honest, there is a real question of at what point does the dominance of size at a time when the U.S. is trying to become an industrial behemoth matter more in terms of industrial policy?
Look out for that conversation, Tom, later this morning.
Those of us of an older persuasion are like, okay, they've made 4% per year for the last 10 years. They've made 2% per year, 3% per year for the last 20 years. Would somebody just put X out of its misery? Is sort of like, why are we doing this?
This hasn't been lost on a lot of people. You know, the ticker, Tom, that you just referenced, X would become available.
Maybe Mr.
Cleveland-Cliffs.
Oh, man.
Yeah.
I just stumbled into that. Sometimes I get lucky, folks. On a Monday, I stumble into brilliance.
Yeah.
Really, X would go to Elon.
Well, you know, if he wanted
wrestling
it, he wanted to take the company. We'll mention that a little bit later. Hasn't the Zuck taken the high ground?
Yes.
On that issue.
Zuck's having a great 6 months.
Mark Zuckerberg looks like an adult.
Yeah.
Dare I say, looks like
some would say everyone looks like an adult, but we won't go there. Good morning, Mr. Musk. Tesla, I guess.
Well, you have gone there.
We're going to go to a serious story. This is heartbreaking.
Oh, this really is, Tom. The pictures over the weekend and over the last week or so. The death toll from wildfires in Hawaii approaching 100, making it the deadliest wildfires in the United States in more than 100 years. Officials expecting the death toll to climb further, TK, as search and rescue efforts continue.
This was dry to begin with, and I'm really interested in the analysis out of this heartbreak about the trends here of the western part of each of the Hawaiian islands, about what the new dry is. What's the new dry in the Mediterranean? What's the new dry in Spain? What's the new dry in Western Maui? And how we have to change how we live.
Now isn't the right time, Tom, for point scoring.
Absolutely.
Down the road, the inevitable conversation is going to happen. It's already starting, Lisa. Could it have been avoided? And what was missed?
Should they have sounded the alarm sooner? Would the alarms have helped if people were used to tsunamis and things like that, and the alarms going off anyway? Should they have turned off the energy supply earlier since they were warned, the power company was warned? All of these questions. Now also, though, the key concern will be, how do you rebuild, considering that this effort is going to cost incredible amounts of money, and it's going to be a long time before they can invite tourists back to really foster their economy?
Yeah, my amateur take on this, of Maui and Lanai over to the west, is it's basically a manufactured tourism. Like there's a Greg Norman golf course at the top of Lanai, and it's very green, and it's very watered. And then there's, what's the one, Manele Bay is down on Lanai. This is a bit away from Maui as well. It's very dry with green golf courses. And, you know, what do you do with a natural terrain and maybe climate change versus bringing in a lot of water? Again, way down the road from the immediate tragedy.
That's the latest information I have, Tom. Your top 3 stories this hour.
We are going to migrate now to an important conversation. This is our conversation of the day on foreign exchange, the litmus paper of the system. Elsa Lingos brings serious ECB and EU cred to RBC Capital Markets Global Head of Foreign Exchange Strategy. Elsa, open question right now. What is your biggest mystery in sleepy August? You're the only one in Europe working. What's your biggest mystery right now forward in foreign exchange?
I think you touched on it earlier, Tom, at the top of the hour, the uncertainty around what's going on in China. And part of the struggle for us as outsiders is trying to understand the reality on the ground when there's actually been a move away from sharing information. The underlying GDP data, the kind of the breakdown of components just isn't there. And on top of that, we just don't have the visibility onto these troubled developers and asset managers' balance sheets.
Does China bring in instability? I was talking about euro yen to 160 and through strong euro weak yen. Dollar yen back up towards 150. Can you see that instability out there given the events in China?
And I think people are reluctant to take positions. As you kind of mentioned, it's the middle of August. A lot of investors we speak to have just shut up shop, particularly if they've had a good summer so far. They're just not seeing the opportunities out there. You know, you've got FX very much in a tight range. I mean, euro dollar to the pip is almost exactly where it was a month ago. And even when we do attempt to get breakouts, as we did earlier in July, it just doesn't seem to follow through. And I think people are really struggling with that dynamic at the moment. Just leaves us all looking at carry trades and selling vol.
Elsa, if everybody's just basically on the beach right now, does that mean when everybody comes back, you start to see more concern about the potential for contagion from China and all of the potential in financial instability in certain sectors?
I think we need to see a bit more information. I mean, clearly the fact that you're seeing developers missing interest payments on their bonds has people concerned. But more than anything, you know, we've been in this situation. I mean, I could go back 10 years when people were panicking about the big China cliff and suddenly growth was going to collapse. And there have been people that have cried wolf one too many times. And so markets are just naturally reluctant to believe that this time it could be happening for real. What I think we're missing in order to get bigger trends is a bit of global divergence. You know, at the moment, it feels like a lot of the themes are affecting a lot of countries in a very similar fashion. If I look at developed markets in particular, whether it's the ECB or the Fed or the Bank of Canada, the RBA, they all seem to be in very similar positions. We need that to break down and diverge in order to get those trends.
But aren't we seeing that in the actual data, Elsa? And I'm talking about, for example, the U.S. and Europe, Germany in particular. We are seeing that divergence. We're just not seeing it when it comes to a currency that seems to have flatlined because everyone's on vacation.
I mean, it's a great question, Lisa, because even more so than the currency, what I find really perplexing is if you look ahead, you look at 2024 expectations, there's still this widespread consensus that the euro area is going to outperform the US. And cyclically, that doesn't seem to add up at the moment. I mean, yes, the Fed has delivered more tightening, but the US also delivered a whole lot more fiscal stimulus. And actually, the tightening delivered by the US is not that much more than the ECB for the kind of local realities on the ground. So I do think eventually we will get that unexpected break lower in euro dollar. That's not the consensus. Everybody's looking for it to trade up at 113 by year end. I just think we may need to wait for the autumn for that to really start taking hold.
I need to rip up the script, Elsa Lingos, and I can do this with you. There's a number of ways to look at the fiction known as the Russian ruble, dollar ruble, euro ruble, and also a basket of ruble. I'm just going to go to the headline drama, Elsa Lingos, of dollar as compared to Russian ruble through 100. I just did a log regression of it back 20 years, back to 07. Elsa, what do I make of the newly weakened ruble? What does it signal given the lack of flows, the lack of information that we have?
And it's very clear that if this is a war of attrition, that puts Russia in a weaker state vis-a-vis the rest of the world. You know, the fact that it relies on foreign currency, hard currency, in order to buy whether it's military goods and so on. And then it relies on help from partners. You know, it relies on high oil prices. And we've seen oil trying to break higher, but it's not really following through. And so I do think that in terms of that war of attrition, it does, all else equal, just put Russia in a slightly weaker spot. Can you read anything in terms of capital flows? Almost certainly not. You know, it's highly kind of controlled currency at the moment.
But it's unraveling. I'm not going to say it's a Zimbabwe equivalent because it's not, or, you know, even the complexities of the Turkish lira. How do they respond to it, or does no one care?
I don't think there is a response as such. I mean, it's a very different economy to even say the Turkish lira, where it's an economy. Turkey is an economy that's dependent on commodity imports. I mean, being in a position where you're a commodity exporter does put you in a position of relative strength, and so there will always be some hard currency coming in. And so, in that sense, the currency, the ruble, is less of a signal for the underlying strength or state of the Russian economy.
Asalinios, thank you, of RBC Capital Markets on the latest in the FX market. Note just dropped in the inbox from Jordan Rochester over at Nomura, throwing in the towel on his long euro call. He says take profit. Previous target was 114 by the end of September, with 116 next year likely. Goes through a range of reasons as to why you should be long the euro, but ultimately, Tom, things have been contained, haven't they? There is some serious risk emerging with what is happening over in China and what's developing in the commodity market for the continent as well, going deeper into summer and out looking into winter.
Yeah, you know, I think there's a lot of different stories here. I mean, one of I think Rochester's not thinking clearly after what Newcastle United did, but you know, the bottom line here is it's range bound, as Elsa Lingos talked about, and you sort of got to get a belief, a setup, a view out 18 months, and it's really difficult to do that right now. I think Rochester's job, Elsa Lingos' job, is really difficult.
Well, let's go back 7 months, and Lisa's brought this up a few times. 7 months ago, I'm sitting there in London, ask a cast of characters who hikes more this year. Just ridiculous conviction around the ECB hiking more than the Federal Reserve in 2023. Going into September, what happens after September, Lisa? A complete lack of conviction. That's the difference between now and then.
Which also is the difference with the economic picture, which it's much weaker than people had expected back then. Elsa Lingos kind of joining with Jordan Rochester there, seeing a break it to the weaker side of euro dollar because there isn't the same strength, because they didn't have the same stimulus that the U.S. had. And yet they raised rates almost the same amount, right? I mean, she was saying if you look at what they're doing, it's actually more tightening, especially given some of the transmission mechanisms.
China's much weaker than we thought it would be, Tom. And as a consequence, to some extent, Europe is as well. The upside surprises have come from the United States.
Balance sheet weaker as well. It's not about flows and income statement. John, not moments ago, but in the last couple hours, yen prints a 145 versus dollar. That's an emotional point.
You emotional?
Yeah, very emotional.
Carsten Bresky of ING is coming up from New York City. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news.
We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
We don't see really any possibility for the Fed to be cutting rates until next year, and that's even under, I think, a fairly benign scenario for the outlook for inflation. They're really going to want to see a trend in the headline figure. It is moving in that direction, but we have a long ways to go before we get to 2%.
That was Daniel Morris of BNP Paribas Asset Management. As we get deeper into the summer and start to think about Jackson Hole, the Federal Reserve annual get-together, just a week or so away. Going into that, your equity market on the S&P 500, the scores this Monday morning as follows. Positive by 1/3% on the S&P. No real drama this morning, stateside, Tom, and the bond market pretty much unchanged on a 10-year, 415. Now, that level is an interesting one, getting closer and closer to the post-SVB failure intraday high of about 420.
That's out there. I'm glad, yeah.
About 5 basis points away.
Are we beyond the banking crisis? And
People
that was
hope
a
we are.
secondary debate this weekend, but nevertheless, there it is.
Well, I like that you said that was a secondary debate, because a lot of people, including Morgan Stanley analysts, were coming out and saying, we can't really say it's over, especially with the Moody's downgrade. And I started to think, okay, is this basically the new gig for rating agencies, is just to turn up the volume, to use your language, John, on certain issues, and then people suddenly have to care about them again?
3 issues: funding costs, capital. What was the third one? Commercial real estate.
It's August. You don't have to remember the third one.
Commercial real estate is something that's going to linger over this sector for small and medium-sized banks, you'd imagine, Lisa, for the time being, for the foreseeable future.
And so this is the reason why you're going to have some of these names bleed lower. At the same time, no one's talking about a crisis. And so now we have to start thinking about, okay, well, can yields stay at this level? And if that's the case, is this a soft landing or is this sticky inflation?
Are we at the price where you don't do a conventional yield analysis and you flip over to do a price analysis? If I have a mortgage rate at 7.53%, price adjusts, amount you can spend on a house adjusts, how much house I can buy, etc.
That hasn't happened.
Same thing hasn't happened. And I wonder in commercial real estate when this gives way. When's it give way? When high yield or, sort of garbage IG bonds actually have a huge yield, which again means price down.
When the refinancing starts, 2025, at another year or so. I can't speak to commercial real estate on that mortgage issue, Tom, but for residential, for people at home sitting in houses with very low mortgage rates.
How do you feel about
this
them?
market's frozen. They're not going to sell.
Yeah, how do you feel
And people
about that?
can't buy with rates at 7 or 8%. You know how I feel about it.
Well, there was a whole article
What did the New York
about
Times? I know.
I
I know
loved
they
it.
New York Times at the end of the article, they called it mortgage envy, didn't they?
I was like,
Mortgage
I
envy.
know who they're writing about.
I know.
Citing John Farrow.
I'm pleased I was inspiration.
Your inspiration for a New York Times article.
This weekend, citing a Farrow sighting at Match outdoors there on their little French tables that they have on 64th Street. He's going, you want what for,
insane
3,000 square feet or whatever. What I did this weekend was simple. I'm starting to learn the map of Germany, that Munich is 355 miles. You go north to Bremen. Is that how you pronounce it? I'm really ignorant on this.
Okay.
No pride here. August 18th, Friday.
Is this about your lost son, Harry?
Werder Bremen plays Bayern Kane. And, you know, I'm learning about Bundesliga, and I called up Counselor Amy, and I said, you know, we got to book somebody on Bundesliga. So, you know, we did.
You made that booking.
If you know, it's like Luton.
Does our next guest know that he's talking about Harry Kane?
Our next guest got relegated. His team got relegated in Bundesliga football, and it's the only, you know, that's why Karsten Bresky's with us, global head of macro research at ING. Your Berliner team, Karsten, got relegated as well. Let me cut to the chase before we get to serious ING work. Is this league the same as Premier League? Is Harry Kane going to go in and get 3 goals a game, or does he have his work cut out for him?
No, but I mean, he plays for Bayern Munich. But the bad thing is, Tom, he actually lost the very first match already on Saturday. That was the Super Cup against Leipzig. So it was in a 0-3. So it was not a good start for Bayern Munich and Harry Kane.
See how we do this? It's just, I'm going to tear up here. Amy is so good to get this. We bring Bundesliga. I can't go forward, Lisa. Bring Karsten in on ING. I can't talk.
I'll volunteer. Yeah.
Karsten, I'm not going to talk about the Bundesliga, maybe another time. I am curious, though, about what Elsa Linius was talking about with respect to divergence. And we've been talking about that for a while. When will the economic divergences play out and market divergences? Are we seeing market divergences with the economies of the U.S., of Europe, and of China?
Well, of course we do see them because the U.S. is doing much better, and everyone fears this soft landing, hard landing, but it hasn't happened so far. With Europe, but I think there are a couple of people, including the ECB, still too optimistic, because here we have the problem of not only cyclical headwind but also structural transition. So my best bet currently is that Europe is in for a longer stagnation, like my favorite soccer club. And China, third one, is clearly also in this very long soft patch. So there is global divergence. I think it's the very first time for a long while that we're seeing and witnessing this big divergence.
Have we fully appreciated how much of the weakness that we're seeing in China is bleeding over into the European economic picture?
Not entirely, I think. Plus, I think we have not fully factored in the fact that China no longer plays the same role for Europe as it did in the past, especially for Germany. Because I think in the past, China was almost in a symbiotic relationship with the German economy. So there was big need for made in Germany products. But this time around, when you look at the export data, also when you look at the fact that China is able to produce the same products these days as Germany or other European manufacturers are producing, China is no longer playing the same role as it did in the past. At the same time, with this weakening domestic economy in China, Europeans will not sell their exports.
Karsten, what will flows do? What I'm most focused on this weekend was foreign direct investment. And obviously the headlines are in the dearth of foreign direct investment into China. What do you presume will be FDI between Europe and America, or Europe and China?
Well, between the U.S. and Europe, it is clearly turning to net positive for the U.S. We have been seeing already a trend of FDIs coming into Europe declining. And at the same time, this Inflation Reduction Act in the U.S. is clearly triggering foreign direct investments from European companies going into the U.S. Well, when you look at U.S.-China, also Europe-China, I think we will see clearly a reduction in both U.S. and European FDIs going into China, simply due to de-risking and the new geopolitical situation.
So critically here, and with the news flow of the last number of weeks, can you get on board with the IMF's 5-year lassitude, the lethargy, the lack of global trade, just a dampening of the economy out to 2028? Can you get on board with that?
I can definitely get on board with that because I think this is pretty much the reality. Well, you don't call this the end of globalization, but I think we should call this the end of globalization as we knew it. So global trade is clearly slowing down. We will see more regional trade popping up, but with global trade slowing down, being much more sluggish, it is obvious that the countries that benefited the most in the past from global trade, and we have a couple of Europeans, I'm living in one of those, they will be hit the hardest from this end of globalization as we knew it.
So, Karsten, the German model, what's left of it? How do they change?
Well, there is not a lot left of it, other than, I don't know, currently buying English players to get to the Bundesliga. No, I really think this is, and not everyone has realized it yet in German politics, this business model has come to an end. A business model that was highly depending on export growth, and it was also highly depending on importing low energy. So with this new world, we will see also a restructuring of the German business model. And of course, then you have two narratives. There is one where you think, all right, maybe German manufacturers, German industry can still embrace new technologies, sustainability, renewables, and then can kind of, rise again after a couple of years. The other one would be a global economy that is moving more towards services. And to tell you the truth, the German economy is definitely not strong when it comes to services.
Carsten, thank you, sir. On the next act for Germany and Europe. Carsten Bresky there, the global head of macro research at ING. Germany and that model, Tom, to outsource defense to America, to outsource energy security to Russia, to outsource economic security to China. It's almost a fail across the board.
Two things there. What I observed from Carsten Bresky, and again, I'm learning a lot about this. I mean, it's just very simple. He said Bayern Kane would not be relegated this year, which I think is, an important piece of information.
Is that headline this morning?
It's a headline. But the other thing I see here, and I think Lisa and I got to give you a massive victory lap on this. You were the first one I heard, John, who said, what does this say about the 14X year heritage of Angela Merkel? You're the first one I heard talk about that, and I think that's going to be a source of serious academic analysis over the next decade.
I wasn't alone. It was many years ago, but ultimately, too many people got too cozy with the views of the Chancellor in Germany. And there's a lot of blowback, and we're still feeling it today. Sebastian Page at T. Rowe Price coming up next from New York City. Futures higher. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From the world of politics,
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will
not only will we remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way